I took my first Uber ride this weekend just to get my 53,000 points. And that 53,000
Yeah, but
points would do-
53,000 points. You see what it got? It is a $50
It's a
Amazon
$50 gift card. Hell yeah, I'm gonna do it.
Sorry. How much did your Uber ride cost?
With tip, 19. So 14 for the ride and a $5 tip.
She would have paid that much in parking if she'd have gone to interest.
Try again.
No, 20.
No,
it was worse.
50.
Well, I don't go to big events.
I know. It
I
was
go to a
50.
hockey game and they charge
Right.
$5.
Right. It was $50. The cheapest parking was $50. Interest bank. So yeah, I mean, you can. Like, I tried this for the first time because my dog keeps being on the kitchen floor,
Right.
and so I tried this. It was expensive as hell. It actually worked. So, but I bought 2 bottles that were over $30. So I got it once. So if you look at it, I can redeem this 3 times.
Okay.
So I already redeemed once, and right now I stand to, if I spend another $24, I get another.
You get to redeem another 32 or
Mhm.
64.
Mm-hmm.
Okay.
So it's worth it.
He's so scared this is going to pop up all these ads
No,
and stuff.
this one does not. I
No,
promise
it's really
you.
good.
It's
Fetch is
really
really
good.
clean.
It's very clean. Okay, now if you're bored, like me, you can go in and play games, and you earn points for levels.
Oh, okay.
Look at that, 6,000 points or 61,000.
Oh,
That's a
I
gift card.
put puzzles together.
That's a gift card.
Yeah.
Do my puzzles.
So yeah. Well, okay, but they've got all kinds of games to choose from, just so you know.
Okay.
If you have a book of that,
I
I'd
know
love to
Deb
look
says
through
she
it.
gets her points.
So
That's
I
why
can
I'm-
do like
Yeah, but when you get it
Township,
done,
Fishdom,
I'd love to take a look.
Monopoly, Bingo. I play 7 games right now.
Okay.
Merge Studio. I mean, and when you download one of these, it'll bring you more in to look at to download. Right now, none of these interest me. So my in progress
Interesting.
ones
I don't know if you
are
guys know what
Panthea,
it is, but
and I've earned 144,000 points off that game.
Yes.
That's almost $3 $50 gift cards.
Right. I quit playing that one because I didn't like it.
I
I
can
do
make
Coin
custard,
Master,
but it takes me usually
Klondike
2 matches
Adventures,
because I always
Disney
lose.
Solitaire,
Katrina always got her
Toon
gift
Blast,
cards.
Monopoly
Custard
Go,
and get along.
Monopoly Go, Royal Match, Domino Dreams, and then this one I didn't like. So, but yeah, so
Yeah, and so and
It's
I
worth
learned
it.
from her.
It's very clean.
And Grandpa
There's no
really,
pop-up
when
ads.
Grandma died,
There's no
he
bullshit.
had to cook.
Now I will tell you,
Either that or starve. So
if you know
can
that
pretty
you're going to
make
need a gift
yourself.
card for something like AutoZone,
all right.
I knew I needed parts for
It's
Toy Store
Halloween week, so we're going to
Takes
start off
30
with something
days,
extremely
2 minutes.
scary.
to process the gift card.
Depreciation.
But during that 3 days, if something
If you're not
happens and you
scared
change your
yet,
mind,
you
can
will
cancel
be.
it.
Oh, okay.
Okay. So I had $100 worth
The
of
one
gift
thing I
cards.
will say about
We found
depreciation
out, that's
is
when we
that
found out that AutoZone
don't
didn't
panic.
carry its parts. So I canceled the
really,
cards
it
that
took me about 5 years to actually
and got
understand the whole
dog
damn
food,
thing.
cat food. And used my Purina. Because I everything Purina, I put major points of shit.
It's a lot easier if you're doing a return that already had it
Oh yeah.
because nothing
And it's worth
happens.
So if you
It
want to
just
try
happens
it,
in
I'll
the
send you the
background.
link.
What we're going to talk about today is setting one up for the first time.
Yeah.
Oh, you knocked off that.
Matt's making a mess. You always take
Well,
over. I
I
don't pick
put
it
my
up.
foot on the ledge.
Well, you guys talk about it. If you want to text me and I'll send you the link.
Okay, thank you.
Yeah, you take all the
It's
points.
time to
first.
pass it there.
All right.
Damn right. Hey, I'm promoting this sucker.
4,000 points for a referral. So
I've gotten 1, 2, 3. I've gotten 3 so far. So.
all right. So today's chapter we're going to talk about the depreciation deduction.
Oh
We're
no,
gonna-
I quit. I'm going home.
Oh.
We're going to talk about makers. Shannon's going to give a presentation about the special depreciation allowance.
No.
Matt's going to talk about listed property.
Yes. Yes, listed property.
Just kidding. He's going to talk about it anyway, so I mean, Like that's a shock and surprise. We're going to talk about the 179 deduction and amortization. We're going to talk about the 4562, setting up depreciation and amortization. And we're going to talk about what happens when you have property that you're depreciating and get rid of it. Disposition. Sold it. Or I smacked it. There's more than one way to get rid of something. It's stolen. Want to understand the property depreciation, the deduction, and how to use makers. Determine and apply the components of depreciation. We're going to talk about what a recovery period is, what a convention is, and what a method is. Yeah, it's a way of acting. It's where the Republicans and Democrats meet, and then
my mind went dirty.
the recovery period is when you need to, the time it takes to recover from your hangover.
Oh.
And if you believe that, I have another for you.
The recovery period is the time when your phone dies and you're waiting for it to charge back up.
Understand the limits of depreciating listed property. Determine what qualifies for special depreciation. When we talk about 179 deduction, that's a special type of depreciation.
Pop off so I can make another one.
Knock yourself out. Well, I don't see you ignoring the coffee.
Hey, I made it.
Understand the ability to understand and have the ability to complete Form 4562. All right, before I start this chapter, I'm going to say one thing real quick, is that this is a scary chapter.
And we're not giving it to you.
We're going to talk about things that don't make a lot of sense. And we're going to talk about things that even if you have an accounting background,
Still doesn't make sense.
it still doesn't make sense because IRS depreciation is different than accounting depreciation.
And it gets really fun when they want to mix the two, like if you're studying for your enrolled agent.
Yeah.
'Cause this is the one area in my enrolled agent studies that I can't get past because I use what I know from taxes on the problems for depreciation, and they're like, "Yeah, no, that's not the right answer." I'm like, "Yes, it is." No.
Not in there. No.
See, that's the problem. And that was the other thing.
They mix the two.
This is where we start that problem where there's a difference between your bank books and your tax books.
Yes.
There is a difference. They will give you different numbers.
Yep.
This one section right here is where I can take an owner-operator truck driver that makes $250,000 a year in gross income and give him a $50,000 net operating loss every single year.
Meanwhile, his bank account's going up because he's actually making money, even though you told the IRS he's losing his shirt.
Right.
And this is all within the rules.
When you were talking about the truck, all that information you have, does it come on that reconciliation?
Yes.
Most of it
Most
does.
of it does. Yeah.
Settlement
Because
sheets.
when you started, because when you started reading those,
Yeah. You were like, what the hell? Yeah.
well,
It-
for
it-
Pete's sake, where honestly does a trucker make any money if they're being charged for insurance?
Right.
You know, and it's
Well,
golly.
for lease drivers will get the settlement sheet. And it's actually cheaper for a lease driver to purchase his truck, his insurance, his tags, everything he needs for that truck through the company because
yeah.
the company gets a better deal on it. Whereas an owner-operator, a true owner-operator, has his own stuff set up. So it costs him a little bit more than what it does the lease driver. But a straight-up owner-operator also gets paid more per mile than a lease driver does. Owner-operator might get $1.25, $1.30 a mile, whereas a lease driver's liable to get $1.05 a mile.
Good luck with that even. Because I'm still seeing 52 and 75 cents. If you look online for jobs, there's still 52
As a lease?
Yeah.
I mean, 52,
for an
50,
OTR driving for a company. Yes.
yeah, as a company driver, 52.
But
But
no.
as a lease driver,
But no, I'm talking about owner operators on the road for, let's say, price truck line, they're still paying them 52 to 75 cents a mile. It's stupid. Truck drivers are getting screwed.
Wow. Okay.
Got out in time, huh?
We talked about nothing to do with depreciation.
Well, it's at the vehicle part, because I'm trying to get into learning a little bit more on Schedule C and stuff like that.
Well, yeah. And that's just it. This is the hardest part of doing a Schedule C. Everything else is pretty straightforward. It's just when you get into depreciation, that's when it gets really scary.
Yep.
And that's why, you gotta be working here for a couple, 3 years before,
Even longer.
or longer.
I still been here 13 years, and I still will say if somebody comes in with something that's got depreciation, I'm like, no, I'm doing this. Hey Shane, this is for you.
I'll set it up and then she'll finish it. But, I don't care. And that's the way we work around here, too. I mean,
Yeah.
If you don't feel comfortable with something, we're not going to make you do it.
No.
don't
But
go
if-
outside your comfort level.
But if we are doing a return that you're interested in,
We absolutely. I
please
will
come
put
and
you-
grab a chair and sit next to us.
Oh hell no! I'll
'cause-
put you at the computer and walk you through it.
Yeah.
We just look like groupies, we're all
I would
sitting
rather have you
together.
do a hands-on. I would rather you have to do a hands-on and learn it that way than sit there and watch. Because me personally, I'll sit there and watch and my mind's somewhere
I'll
else.
sit
Yeah.
down and
It does me no good as the office supervisor and the general manager for the entire entity to be the only one that knows how to do it.
Yeah.
Yep.
That's no good. I gotta have other people know how to do this.
Your hands-on, she wants to-
All right, so depreciation reflects the decrease in the value of an asset over the period of time that the asset is scheduled to be used. The first part of that concept is pretty solid. You use something up, it loses value. We've all heard the story about you buy a car, and the minute you drive it off the lot, it's now worth $20,000 less.
Yep.
That's depreciation.
Should be illegal.
The next part of it is the period of the asset being used. Well, that's not really set. I mean, it's set in stone, but in a silly way. Somebody just decided, well, we figured that this thing is going to last you 5 years. And if you get 20 years out of it, great. But what we're going to do, what we're really saying in that sentence is that I'm going to take what you paid to get this thing and divide it over a class period, say like 5 years, and we're going to take that expense and we're going to divide it up over the 5 years. That's depreciation in a nutshell.
So,
I don't get to expense my $20,000 all at one time.
Right.
I expense my $20,000 over 5 years, 7 years, whatever. And we'll get into more of that class life here in a minute to make a little bit more sense of it. So instead of having this big thing, I'm spreading it out. A computer is, you're gonna drop $2,000, and I'm gonna spread that over the next 5 years
Right.
on my books. Components such as age, wear, and tear determine the decline in value. Depreciation for income tax purposes is the method used to recover cost or basis in income-producing property through tax deductions. Use this depreciation rules to deduct your basis, typically the cost in assets such as computers, equipment, vehicles, buildings, whatever. Whatever you need that's expected to last over 1 year that you use in your business.
Depreciate. If you think about it this way, depreciation for business takes the place of a business expense for what you would have to pay monthly. So if you bought a warehouse, you got a $200,000 loan, you bought a warehouse for your business, you're making a $3,000 a month payment on that warehouse. You can't take that $3,000 a month that you're paying on that warehouse on your loan as a business expense. So what we do is we say, okay, it's worth $200,000. This is how long it should last you. We will allow you to take that $200,000 in yearly increments
What do you want?
over this time span.
Give it some time.
Yeah.
You're trying to do what?
For most depreciation deductions you claim, you must complete 4562, the depreciation
I ain't
amortization
getting no shit. I don't know
form.
you.
I'm only filling out this form once.
Yes.
No, bye.
Depreciation lasts for multiple years, but the only time I'm filling out this form is when I first buy it. Now I can have multiple forms over multiple years. That's the fax
I
machine.
know it is.
United Mortgage
I
again.
don't know. I want to see. Thank you for calling Liberty Tax Company.
So I only use that form. After that, it's just a depreciation worksheet that runs in the background.
Hello?
If I have a company that has active depreciation, but they don't buy anything this year, I'm not filling out the 4562 because I have no reason to. And I don't have to do anything about depreciation because it's automatically going to happen.
Can
But-
can it skip a year if you don't have a new anything?
No.
What do you mean?
Hello?
Anything to depreciate, like, okay, your depreciation is over, or you get another piece
No,
of
it happens
money.
automatically.
Yeah.
If you have a 5-year property, it's going to be depreciated over the next 6 years. Which I'll explain that in a minute.
So the first year you put it in, you're fine. The next year when that client comes in and you're going through and you're looking at your review forms and you see that depreciation sheet,
Worksheet.
that worksheet, all I ever do is click on it, save it, and leave it because I know that that's going to depreciate over the next some
Yeah.
years. I just make sure
As soon as
in our system that it's saved that year again.
Yeah, as soon as I open up the return for the first time on a returning client, it's already done the depreciation.
Well, that's
I haven't done a damn thing
to open it.
except open it, and it's already done the depreciation.
That's
Now, if I have to add new things to it, that's something different. But if I don't have to add anything, I'm already done with that part, and I didn't do a damn thing except open the return.
And if you add multiple depreciation sheets, when you go and you look at view the return, don't freak out when you don't have 10 individual depreciation sheets.
Because
Because-
it will lump them all together.
Yes, it'll lump a whole bunch of stuff together.
4562 can cover a whole gambit of different properties.
Yes.
So let's just kind of put that a pin on the side, although we don't go into that detail a lot. But just understand that, I'm going to fill out a whole bunch of things, but it might only have to feed one 4562 because it can handle multiple different types.
Right.
Your depreciable basis is usually your cost, what you paid for it, and that includes everything it takes to get it up and running. So not only did I pay for the cost of the air conditioner, I paid the sales tax on the air conditioner, I paid the delivery fee on the air conditioner, and I paid some schmuck to install the air conditioner. All those things go added together are my basis. That's the number I'm going to start depreciating. It's not just the cost of the air conditioner. It's all these other things that I had to pay to get it up and running. Recovery period, what the useful life. How long the asset will be used? Well, that was just assigned by the government. They're just saying, okay, we expect this thing to last 5 years. If you get the last 3 years, well, that's inconvenient. If you get the last 10 years, well, bully for you. There's a few different types of depreciation method. One is a straight line. We take this cost and we spread it evenly over the useful year, the useful life of the thing. Generally, straight line is only used in property. It's the same amount every month until you're done. The other depreciation method is called accelerated or double declining basis. Allows for a larger depreciation deduction in earlier years of the asset's life, which in some regards actually is logical. I'm using it up more in the first part than I am in the second part. So my depreciation tables, which you'll see some coming up, are front loaded. The bigger expenses are taken in the first couple of years. Conventions, half year, assumes that all assets are placed in service for the half year of the acquisition year, regardless of when they are placed in service. That's the default.
Yep.
I buy a whole bunch of stuff, and it assumes that I bought them all on June 30th,
Or by June 30th.
or by June 30th, however you want to look at it. Actually, it really assumes that I bought it and put it into service on June 30th. Mid-month. This is usually used for real estate because it's being instead of depreciation being figured once a year, although that's going to be a confusing statement to say it, but
For rental real estate and for rental real estate and for
actual real estate.
and for business real estate,
The
you
depreciation
start your depreciation in the month you put that into service.
Uh-huh.
So if I buy this strip mall right here with all of these businesses in it, I buy this whole strip mall. If I buy this strip mall in November, then when I go to put this strip mall on my depreciation schedule, I put down that I bought it in November. So my first year of depreciation is only going to be 2 months of depreciation.
Technically a month and a half.
Right. So, but the next year, when
You
I
get all 12.
when I go into 2026 for that depreciation, I'll have the whole year.
Mid-month, like we said, is basically used for real estate. Mid-quarter. This assumes that no, it's not assuming. I purchased most of my stuff in the last quarter of the year, thinking that I'm going to pull something.
I'm gonna buy $7,000 worth of equipment in November.
And then take a big, huge deduction, even though I only had it for a month and a half.
Right.
Well, this stops that. It says, oh, you're going to do that? Okay, well, if you bought the majority of your stuff in the last quarter of the year, we're going to adjust it so you only get a quarter's worth of depreciation
For everything.
for everything that you bought all year. If I bought more than 50% of my stuff in the last quarter of the year, it's going to assume that everything was purchased in the last quarter of the year.
40%?
I thought it was 50. We'll find out.
I thought it was over 40%. But yeah, if you spent $7,000 in the first half of the year, and all of that would be technically
Mid
half year
half year.
convention, and then you turned around and instead of you bought $7,000 down, and then in November you turned around and bought $10,000 more worth of stuff. You've just put all of that stuff that you bought in the front end of the year on a mid-quarter convention.
Yeah.
Because you bought more stuff at the last quarter of the year than you did all throughout the rest of the year, hoping to get, like Shane said, a big depreciation deduction to lower the amount of income tax and self-employment tax you have to pay,
Right.
or corporate tax.
And
that
that's
you'd have
what
to
this
pay.
stops. We're not going to allow you to take that big, huge deduction.
Yep.
Not on the first one.
So do a lot of small companies not understand about depreciation? That
Yes.
it's available?
Yes, they do.
They
already
don't
do
understand
that.
squat.
Oh,
Well, neither do you. I mean,
Yeah.
and you've been doing this for how long?
I-
Let's face it, it's not the easiest thing to get your head around.
yeah.
And most people won't even know this.
Well, for one, we've never had, well, Matt probably has, but
I have too, but they weren't
returns
doing it.
come in.
They weren't doing it on purpose.
No.
They had no idea that it actually made a difference.
Doesn't sound
The-
fair.
Well,
You got to think about this: is that this is trying to equal the playing field. Instead of saying that I'm going to get a full year's depreciation, or in this case, a full half year of depreciation, and I bought everything in December, so therefore I'm going to take advantage of basically 5 months. That's what this is going to stop. It says, no, you can't do that. We're only going to give you 1 quarter on that first year, and then it makes it up. They'll give you 3 quarters in the last year.
Yeah.
So you'll get more the last year than you do the first year, as opposed to this, where it's
So
basically
eventually you do
50-50.
get-
most
You get it. It's just when you get it is different.
most companies don't realize this because if you think about it, most of your cash basis companies, most of your small businesses don't know in March, don't know in August how much money they've got to spend on this, or this. But in November, I can go back and look at my books and I'm like, oh, well, I'm $40,000 ahead. I need to replace this, I need to replace this, I need to replace this, and I can do it now
Yeah, it's the big question.
because I've got this $40,000. So I go out and I buy a bunch of that stuff. I'm not, as a business person, I may not be trying to game the system. It's just in November, I know how much extra I have to replace what I need to replace.
Yeah, it's the big question of can I afford to replace it, or do I have just enough money to fix it?
Right.
It's
And-
the big question between the two. Now, the reason why this thing, and you know, and really, if you pay attention to a lot of IRS rules and regs, they're in place because somebody tried to game the system.
Right. A big company with an actual accounting team
They know.
went in and said, you know, by the end of the year, we're going to have this. Let's just buy a bunch of stuff here and we'll get a half years of depreciation on it. We'll get a big bump. And the IRS went, yeah, no.
We're not going to allow that anymore.
So that's basically kind of what's going to happen to Brett, because he's buying all these computers
Yeah, he's going to
at
have,
the end of the year.
and it's not his fault.
No.
But that's the way it's
No.
going to
It's just
play
the
out.
way it fell.
Yeah.
Now, I mean, if I'm Brett, and I will probably take, if I could, I'll take special depreciation.
Right.
But let's not confuse that.
No. no.
What you say is a true statement. It's not because Brett was trying to game the system. It's just that this is when it happened.
Mhm.
This is when the requirement hit.
A lot of people are going to have that problem.
Yeah, this
Okay.
year,
Did that this year.
because Windows 10 no longer has support. Well, our company says, you know, our company tech support says, hey, if you're running Windows 10, we're not going to support you anymore. If you have a software problem, that's you.
That's your issue.
We're not going to fix it unless you have Windows 11. So we're trying to get machines in here with Windows 11.
Yep.
Which, thankfully, and I mean, I'm looking forward to it because all the computers in here
They're so old. We have
2010?
problems.
Yeah.
We have problems with them.
they've been upgraded from Windows 7 to Windows 10. I mean, let's face it,
Yeah.
it's a wing and a prayer. I've had to install memory chips on these things just to keep them going.
And I've got one that's supposed to have Windows 11 on it that I can't get to come on.
So you need another tower?
Well, no, I don't know why the tower won't come on unless it has to do with the fact that we're using an older used monitor, even though it's display capable, HDMI display capable. The system
It's not recognized.
is not recognizing it. That's the only thing I can think of
The card might not be working because the drivers aren't installed yet.
Yeah, but I thought
It won't
the
even
tower
turn
itself
on.
won't
Oh.
stay on.
Then
Yeah,
I
the
think
tower
turn
won't
on.
even turn
then
on.
your power is bad.
It's getting power. You can see it in the back where the
No,
It might not be enough.
that could be too.
What do you mean it might not be enough?
Well,
Power
let's
cord's
face
not
it. If
good enough.
it depends on what they did to it before they gave it to you.
I mean, I plug it into the wall.
But
I've got
there's a
it.
different power supplies. Some are 500 watts, some are 1,000 watts.
Yeah.
I'm just throwing numbers out. I'm not that big of a computer nerd, but I do understand that different power packs have different power, and different computers have different requirements to get it to go. Where a 500 might turn on the lights and look all pretty, but it's not enough to make the processor go.
Oh well, I mean, we don't have the inline power packs. It's a straight cord going from.
I know, but
Yeah,
in
but
the
it's
box,
inside.
inside the
Inside
the
computer is a
computer.
box.
Okay.
That's what's generating the power.
Okay.
All right, you buy an asset for $1,000. You estimate that you should be able to use the asset for 10 years before you have to get rid of it. At the end of this 10-year useful life, you estimate you should be able to sell it for its $2,000 salvage value at its absolute simplest in theory. You'll be able to take an $80 depreciation deduction for the 10 years you hold the asset. That is just the oversimplified version of all of this. And at the end of the day, the IRS really doesn't care about salvage value.
No.
That's an accounting term. They're mixing the two worlds together here on this slide, which is part of the reason why it gets confusing.
Because as far as the IRS is concerned, if you keep something for its entire depreciable life and then get rid of it, there's no taxable event. You don't have to give back any of that depreciation.
Yeah, but wait. Yeah, I got a great story for you coming up on that one. I think I've actually previewed it once, but I'll do it again. All right, so some key words that we have to understand when we're talking about depreciation. Amortization. This applies to intangible assets, loan costs, customer lists, goodwill, and patents.
Startup costs.
Now, well, those are some other things, but let's face it, the customer list is valuable.
Yeah.
We have a customer list of people who did their taxes here last year and the year before
and
that.
who
And
didn't.
yeah, and who didn't come back. All that stuff is valuable.
Yep.
The Liberty Tax name is valuable. McDonald's is valuable. You put that name on your restaurant, well, first of all, you better be a McDonald's. But second of all, everybody knows what they're going to get when they walk in the door.
Everybody expects a certain level of quality
And that's just
based
from
off of the name.
off the name. Depletion. This applies to natural resources: oil, gas, coal, timber, sand, whatever. Stuff that doesn't renew. Although technically timber does, but it just takes a long time.
Yeah.
It's a special class of depreciation, we'll call it.
And thankfully, we do not do any tax returns for quarries.
No, but we but we do some tax returns for people with wells.
Yes.
And I'll be honest with you, we only learned about depletion and how to use it just a few years ago. Because it's just something that is never greatly explained. But you take a percentage of your revenue, and that's what you're actually taking as a depletion expense under depreciation.
For us, typically, the people that come in with a 1099 because they're getting $40 a year or $40 a quarter in royalties for a well, we're not worried about depletion on them. Winger Oil, who owns those wells and is pumping it out of the ground, they're the ones that are going to get the depletion.
Well, that's not completely true because Shannon takes depletion on her natural gas.
On my natural gas and my oil.
It's a significant number for her. It's a couple of grand.
Not this year.
Well, again, it depends on your revenue for the year, too. It's dependent. Depreciation, this applies to tangible property. And it's generally required for property that has a useful life of more than 1 year. Computers, furniture, fixtures, automobiles, office buildings. Tangible. I can touch it. It exists in the physical plane. You didn't know we were going to talk about physics today, did you?
That's okay. I'm more of a Leonard Wallowitz than I am a Sheldon, so we're all right.
If the property will last more than a year, you can't generally, as a general rule, can't deduct the entire cost of it in 1 year. I have to spread it out over a set number of years. To claim this, I need to know basis. How much did it cost for you to get this and in a working condition? I have to know the type of property, what it is. I have to know the number of years to depreciate the property and the depreciation method that we're using. Well, the number of years I'm using to depreciate the property depends on the type of property. And the depreciation method depends on, well, first of all, the type of property it is. And second of all, when I bought it. Hey, Kelly.
Hey, Kelly.
I heard
There's him finally.
Generally, the business income expense can be deducted directly from your business income. So you need to have a Schedule C, a Schedule F, a Schedule E
Yes.
before we're doing any of this. If you're just Joe Blow tax guy coming in here with your W-2s and you're going to tell me about depreciation, I'm not listening because you don't have it. You have to have a Schedule C. You have to have a Schedule E. You have to have a Schedule F.
Number one rule of depreciation. You cannot depreciate personal property.
Yeah.
Period. You can't go out, buy a brand new car, come in here and go, well, I just bought a brand new car, I want to depreciate it over the next 5 years. Yeah, no, you can't do
You can't
that.
do that.
It has to be tied to a business of some kind.
They just drove by and didn't pick up my trash.
Bastards.
Yeah, and I just checked my billing due till November 14th.
However, certain expenses the IRS does not allow you to subtract the entire amount in which they occur. For example, a painter in business for yourself, you can subtract from your income the cost of your paints and your brushes.
Yeah.
Because they're not expected to last more than a year. Hell, they might not last a
a
job.
month.
Especially if it's outdoors.
That, yeah,
Yeah.
That's only by job.
yeah. And if you're lucky, you might not get the last of the day if it's warm enough.
Right?
I've had that problem.
Oh my God.
I shouldn't be painting, but I really want to get it done. But it's drying faster in my brush than it is on a damn wall.
And it's pulling your bristles out.
Yeah, it's pulling the bristles out and clumping them together. I need a new brush. However, if he bought an industrial sprayer,
You're going to have to depreciate
you're gonna
that
have to
one.
depreciate that because it's expected to last more than a year. Now, if I go rent it, that's an expense.
Yes. Same thing with a power washer.
The rules
Rent
of
it, it's an expense. If
The
you buy
rules
it,
of any depreciation system dictate which property must be depreciated, how much of the cost can be deducted in any particular year, how much can be deducted next year, and how many years do I get to deduct it. Only qualifying property can be depreciated. The IRS divides the qualifying property into classes and assigns a recovery period to each. Some conventions govern how the depreciation deduction is handled the first and the last years the property is in service. Well, that's actually kind of almost true of all of them, except on the half year, or except on the mid-month, where it's the first and the last month
mm-hmm.
is differently handled than the rest.
Right.
Each class and convention pairing has a table that tells you the depreciation percentage according to which year, month, or quarter depreciation started or stopped. And generally, you figure your yearly depreciation deduction by multiplying the rate basis times the qualifying property. So if I'm allowed to take 30% depreciation this year on that thing, then I take my basis times 0.3, and that's my expense on depreciation for this year, for that thing. So an example, if I have a $500 copier to be used in the office of the painting business. According to IRS rules, copier is a 5-year property. Therefore, it's a 5-year recovery period on the expense.
Mm-hmm.
Based on this, you select the correct depreciation table. Find that this year, since the first year of the copier is in service, I could take 20% of the cost as a deduction. 20% of that $500. Means that $100 will be subtracted this year from your business income as an expense for the copier. It might have other things going on, but right now we're just talking about the copier. Next year, year 2, depreciation allows for 32% of the cost to be taken as a year 2 expense. 32% times $500. And you can see that already it's only been 2 years out of 5, and I've already depreciated over half the cost of the copier.
Yep.
You said it's front loaded.
And you can, on depreciation for some stuff, you can lump it. So if you opened up a business like this and you bought 4 desks at $300 a desk, you don't have to do 4 individual depreciation sheets. You can put down office desks, $1,200, and that covers all 4 desks.
There's points that I recommend doing that. There's points that I don't recommend doing that.
If you have to replace one,
Then you're screwed. It becomes more complicated. But I'm not worried about a desk being destroyed in 5 years. Computer, on the other hand, I might do individually.
yeah.
What he says is a true statement. I can lump things together. I can lump everything together, like he said. Anything that's class specific to one thing, I can put them all together and call them startup costs and depreciate the entire thing over a set period. I don't necessarily recommend it because, like I said, you know, if one thing goes south on me in that group, then I've got a task trying to recapture it.
Get an unreasonable client that falls and crushes one of your desks.
Karate chopped it.
Thinking more along the lines of arguing and stumbled, tripped, fell onto your desk and crushed it.
Depreciation deduction is the percentage of the basis of depreciable property that is taken yearly over the useful life. The IRS is the one calling the tunes here. You should claim the correct amount of depreciation each tax year. If in error, you did not claim any or all of the depreciation that you were entitled to deduct in any year, you still must reduce your basis in the property by the full amount of depreciation that you could have but didn't. Which only kind of makes a problem when I go to sell it. When you dispose of the property, the depreciation you deducted or should have deducted must be subtracted from the basis of the property to establish your taxable gain or loss, even if you did not deduct the correct depreciation amounts through the year. I had a guy that, you know, his first tax preparer didn't know squat about depreciation, and he bought these properties in Oklahoma. And nobody set up depreciation. Now it's 5 years down the road. And I get it.
You do an amendment and fix it.
Have to.
That is an option. I think that's the option I ended up doing. I got to keep in mind that we were still over there when this happened. But, you know, that's 5 years. Well, what, you know, this is property. I'm talking, it could be 20, 25 years.
So if you had to do an amendment, would you do the amendment cost now or when you did it? Because amendments cost.
They do, and I have to amend each and every year to recapture it.
Or would you go by the years that it is or
I have to do it specifically for each year.
no? So then it would be the cost of that
Well, it's still $100 per year.
It's $100.
year. That's what I was wondering.
Times
Here.
5.
I-
Well, I mean, he should have went to a better tax preparer, basically. Is what it boiled down to. Now there is a secret around that.
Do you
There's
have to pay that?
there's a form that you can fill out to the IRS that you can catch up. You can do that.
They're hoping you click on the link
So-
so they can get access.
Like I said, you know, there's a different way of fixing it, and that's the way I actually did it. Is that I filed the proper form with the IRS saying, okay, he missed it these years, this is a catch up.
Yeah. You wouldn't necessarily have to go back, because keep in mind, anything past 3 years, he's not going to get anyway.
Yeah, he was missing expenses that he could have took. He was paying more tax than he should have.
So, I mean, you come in for 2025, if you ran into something like that, and they're there to do their 2025 taxes, if you wanted to amend 24, 23, and 22 for him, as long as you did it before the end of the tax season, that would be beneficial to your client.
Yeah.
Because if you go beyond 22, the IRS is going to go, yeah, we don't have to worry about that.
Yeah.
The
Thanks for getting the paperwork corrected, but we're not sending you your money.
right.
Right.
So, I mean, for something like this, I wouldn't worry about going back any further than what he would get any kind of relief for.
But if I don't, when he goes to sell it, he actually has to act like he did it.
Right. Well, in our
Yeah.
in our system, if you have somebody like that, when you're putting it in for that first year, you're going to ask them, well, when did you put this into service? Especially if he brings you his last year's return, which if you've got this, you will ask them for their last year's return. That way we make sure we keep everything in line.
Yeah, I need that depreciation worksheet from last year.
Right. So if he brings it in and he doesn't have it, but he has a depreciable asset, we can put in we ask him when did you put this building into use? When did you start using this building? Oh, 2002. Okay. So when we put in our depreciation schedule for the first year, we put in that he put it in 2002.
And didn't take any depreciation expense.
Yeah, we don't have a list of anything, so when we're filling everything out, we list no depreciation expenses at all, and it goes in and it figures out, okay, well, this building has been in service for 23 years, he should be at this point, and that's where they start him.
Yeah. So I mean, it could be a problem. Now he didn't come back to me because I think he went back to somebody in Oklahoma. I don't know why he was in Kansas for just that short period.
Kind of like my Colorado guy. He was here visiting his son. He lives
Yeah,
in Colorado Springs, and he needed to get his taxes
Yeah,
done.
he needed to get it done.
That was interesting.
I just hope he didn't go back to the same guy because that guy was not doing him a favor. Claim depreciation, the taxpayer must be the owner of the property and must use the property in business. Well, that makes sense. If I don't own it, I can't depreciate it. Somebody else is. Sierra took out a loan to buy a cargo trailer. She's a carpenter, uses the trailer in her business. She can depreciate. She owns it. Well, actually, technically, the bank owns it, but that's not a problem here.
She owns it as long as she maintains her payments.
Right. So, touched includes both real and personal, which is kind of a misnomer because personal property in this case is not personal property to you, it's personal property to the business.
Yeah.
Go figure. Real property, land, buildings, generally anything built or construction on land, growing on land, or attached to land. Fun fact, you can't depreciate land. So if I'm depreciating a house, and they told me they bought the house for $163,000, I gotta find out how much the land was, and subtract that out to come up with my basis for depreciation. Because I can't depreciate the land. Why? Because no matter what happens, the land is still there.
Yep.
Tornado comes through, wipes out the house and everything that's on top of it. Guess what? The land's still there. Can't depreciate it. Personal property, cars, trucks, machinery, furniture, equipment, anything that you can see and touch except for buildings. Like I said, personal property is not personal property except that you look at the business as its own entity. Then it's personal property to the business. That's why I hate that term.
Basically, personal property is anything that you own that is not connected to a business that you operate.
Except for, in this case, personal property is belonging to the business. Technically, that combine is personal property to the farm.
Right.
Intangible property. Property that has value but cannot be seen or touched. This includes items such as computer software, copyrights, goodwill, franchises, patents, trademarks, trade names. I already talked about how some of those things have value. When they talk about computer software, this is proprietary software.
Windows 11.
Is proprietary software to Microsoft. They depreciate it. Drake, Fusion.
Microsoft 360.
All those things are depreciated. You can't really touch them, especially Microsoft Office now. You can't go out and buy a CD of it. But that's not what we're talking about. That's computer software. In effect, it doesn't exist.
I think that was Shane's.
It's the questions.
Oh, this is your.
It's the classwork that I may or may not be getting to.
Oh, okay.
Jordan rents apartments in the apartment building he owns. The building, the furnace, the garage, the trees, the shrubs are all real property owned by Jordan. His computer, the furniture in his office, the truck he uses for a business are all examples of tangible personal property that I might be able to deduct. You can only depreciate property only if it meets the following requirements. I gotta own it. It's got to be used in business, and by this business, it can also be used as a rental.
This here is
I'm
what the
renting
company
out
does,
a house.
Okay, this is,
It must have a determinable
volume.
useful life.
this is the cost of it.
Well, the IRS has tables for that, and in fact, it's so vague that there's actually one of them that says, "Well, if you can't figure out what to put it in, put it here."
210 on this one.
Right.
So your depletion
It
comes
must
off
be
of
expected
my
to last
price,
for more than 1 year.
my total.
Otherwise, it's a supply.
So what was it? $40? Was that $40 or something?
Depreciation does not apply to property being used for
Month to
personal
date.
purposes.
Oh no, I'm sorry. This was last year's or last month.
Property must be something that wears out, decays, gets used
Yeah,
up,
this is
becomes
September.
obsolete, or loses its
So,
value from natural causes.
That's what I got last
In
month.
other
This went
words,
down about
It
$40.
has a limited useful life. The
So,
land is not
all this
limited.
total here. the
It's
depletion
always
comes
there.
off this price,
That's why you can't
off
depreciate.
my amount.
Right.
Some other thing that's
Not the
not
company's
depreciable. Inventory.
Right. So for
Well, that's a
this year, your
supply.
gross value is $859.72 so
Mhm.
far.
Supplies.
Right.
Now you'll add
I
3
better.
more
I'm
months to
hoping that I
That's
don't
gonna
have
give
my
you a
inventory
gross
for more than a
year-to-date.
year.
Right.
Otherwise, I'm not doing very good.
So
The depletion
That's-
will come
Most
off of that,
items
and
placed
it's
in
like
service
15%.
and disposed of in the same year.
so you'll just do 15%
Well, I can't
of that.
depreciate it
Mhm.
because I
and
don't
then
have
take
it
that as your
anymore.
depletion.
Mhm.
Okay.
Mhm.
It might have been
But
something
then
I should have been
somehow
able to
I looked at it,
depreciate,
and I'm certain that
but I
more
turned around and
than
sold it
this
for
one
whatever reason.
Is all these taxes that I paid, I can't get these off. Because I've never
I
paid
might
these
have
off
to
before.
report my gain on
I
the
just
sale
deleted them every time I go.
if there is
Your
one
severance tax,
Yeah,
all that.
as
I
a
know.
capital
No, this is
transaction.
this. I can't count this. This is not mine. You're looking from here.
You must capitalize and
Over.
depreciate improvement to your
So-
property.
No,
Improvement
this is
generally
the
adds to the
owner's.
value of the underlying property or extends its useful life.
Um,
You do not depreciate repairs and replacements that do not add value to the property or extend its useful life. The good example on this one is that leaky roof. Just one spot. I just have a repair in that one area where the roof leaks. That's a repair. Replace the entire roof. Well, now my roof is brand new. It's expected to last for another 25 years, according to the shingles. So I have to depreciate it out over what the IRS says I need to depreciate it out over. Shingle is going to be 27 and a half years. If I replace the the furnace goes bad, and then I get the furnace repair guy in there, and he just says, "Well, you know, you just need to replace this sensor." That's a repair. Well, you know, the heat exchanger's cracked. You need a new furnace.
Depreciating.
I have to depreciate the furnace over. I think that's a 7-year project.
7 years.
Even though it's in a rental house, that the rental house is going like almost 30 years, I get to look at the class of things inside of it as I do it. it'll make a little bit more sense coming up, I hope. James completely replaces the roof on his apartment building. The new roof increases the value of the property, so he must depreciate the cost of the roof. If he merely repairs a leak around the chimney, that's just the cost of repair in the years that that's made. Runs out there with some caulk, his handyman goes up on the roof with some caulk and goes around the. That's just a repair. You begin to depreciate your property when you place it in service for use of your trade or business. For depreciation purpose, you price the property in service when it is available and ready for use. Even if you're not using it, it is in service when it's ready and available for its specific use. Our problem here is like, I had a guy that he's a landlord, and he bought a property at auction. Out in the middle of no place in Butler County, but it was on Thunder Road. So I'm going to call it the Thunder Road property. It's actually on Thunder Road. It needed help. He bought it at bargain basement prices because it needed basically to be gutted. I can't depreciate it right now. All those repairs that he's putting into it, I can't depreciate because it's not ready to use. You can't rent it out. I have to keep track of all his expenses and put them into an escrow account, basically. That'll start depreciating once he gets the property ready to go. So I'm going to have two things already. I'm going to have the house that he bought, and then I'm going to have all the repairs. Those are two different schedules. And he's going to start depreciating them as soon as the house is ready to rent. Jack bought an apartment building in January and started advertising immediately for tenants. Didn't rent the first apartment until April. The building was ready and available to rent in January. So January is when he starts his depreciation. Has nothing to do with when it actually started being used. It's the fact that it was available to use. It was ready to go. That's when he starts his depreciation. Stop depreciating your property when you've deducted all your costs or when you retire the property from service, whichever
So
comes
if I'm
first.
looking at this right,
The property is retired from
this
service when you permanently
this
withdraw it
segment's
from
this
use of your trade or
configuration,
business
that's what you get.
by sale,
The
exchange,
total-
abandonment, or
total-
destruction.
I get this number here.
This is
Well,
saved.
that's right.
Do we
I
need to
don't take
describe
off.
that? Yes,
It's
let's
only
talk about it.
Okay,
Well,
so that
sale
what they're
is
doing is they're
obvious.
lumping your severance and your conservation tax
Exchange
into
could
the
be
state
something
tax.
Yes.
interesting
Okay.
because we're not talking
So
about
total right now I
necessarily
have 39.
I traded property A for property B, but that's actually
And
one of the
I have to
components
pay
that's in
property
play
tax.
here. But
To the
exchange
county.
could also be,
So I get to write that off too. Now that I've
instead of
always
me
written off.
renting out this house, I
And
decided I'm
I
going to move
do-
into it.
I do like some people because it's property tax. You
I've
know,
exchanged
December
it.
and May.
Maybe
I
I
pay all of mine in
moved,
December.
started renting out the
But
house
if
I
I
was
don't,
living
if I
in.
don't, and I pay it in
It's an
May,
exchange.
then I usually pay the next one in December. So I got 2
Abandonment.
years. One
Car broke down
Yeah,
the
but
side
that
of the
means you
road.
also
It ain't
lease it.
worth squat to me. It's going to cost me
So,
more to fix
If
it
you
than.
didn't pay it,
I'll
if
just
you
leave it
didn't
there.
pay 25 in
I'm done with
December,
it.
Then you're not going to have property tax for 25.
That's not
But if you
depreciated.
pay 2 years in
I don't
December,
have it
But the
anymore.
property tax is only like $100.
Destruction.
It's
Tornado came by
not
and
bad.
took it out.
So this is what I get now.
I don't have anything to
Natural
appreciate
gas,
right now, do I?
I don't get savings like this. They just mail me a check.
I
This
can't
is
rent
direct
out the house because
deposited.
the tornado put it over
That's how I
there.
get these statements.
That's no longer my
Okay.
house.
The natural gas.
But I'm still left
they
with
just mail me a
land, but I
check.
can't depreciate the land.
does
They
it-
So
do
my
not do direct
depreciation
this
was
deposit.
stopped.
No.
Does it,
Nope.
it doesn't have any
Nope.
of this information on the check side?
The 2018
And I
Steve
have not
purchased
bought
a
it
safe for
once
use in his
this year.
business. Safes
I'm
are
not
second
blaming
year
everybody on
property.
Trump, I'm sorry.
Each year he's been taking depreciation deduction to
Well,
recover costs.
because I was getting checks
2024
every
he
month, and now I'm
sells
not
the
getting
safe.
nothing.
This is the final
So
year that he
what
can
the
take
hell
the
happens with the
depreciation
natural
deduction from
gas?
cost of the safe.
Yeah, and this is pathetic. Because usually by this time I'm at like $2,000. So, but yeah, that's what I get.
Makers provides tables
So,
that
yeah, I
give you the
decided this year
depreciation
I'm gonna
rate
start
for
putting
each year
out
of the
there every
properties
month
in service.
and put it in a
The rate
packet,
is
so
the
I have it.
percentage of
I
tax
know I
basis
could wait
of the
and just get
property
the
that
last
you can
one,
deduct
but
in
I'd rather
a year.
have all of them and make sure there's no
Makers
mistakes on them.
is different
Yeah.
tables
Okay.
But yeah,
of all sorts of fun.
and like this year, there were
Makers
3
applies
months,
the
3 or
most
4 months
tangible
I didn't even
depreciable
get a
assets
payment
placed
for
into
oil.
service after
So that
1986.
tells me that either
It's when the IRS basically
the
kind of
lines are
started
under
this.
maintenance,
And here's your
or
other
they
thing
were
about
broken.
this: is by 1986, let's see
So,
here.
But these laws are
Yeah,
old.
not quite.
They're
There's
not
still
right.
one thing that could be.
Oh,
No,
So
should
when
be
are they
almost
gonna run
depreciated
out?
on everything
Right.
you can put in makers.
maybe that's what.
Even if you put it in service back in '86.
If it's and
You
this
should be
one-
fully
this number here,
depreciated by now.
I said, okay, I asked my kids, 'cause
Intangible
y'all got
property is
5
generally
kids.
amortized. We'll discuss
Total.
that
I
later.
got,
Makers
Kelly's
cannot be
daughters
used to
and
depreciate
my
the following
sons.
property:
Okay.
intangible,
I said,
natural
okay, how are we
resources,
gonna split this up
certain
between
real and
5
personal
kids,
property
right?
placed in service before
That's
1987,
pathetic.
any
$100
films,
a month.
videotapes, and
$100 a
or
piece.
recordings.
So I told him,
Those
I said,
depreciated.
okay, who wants
those
the- who
depreciate
wants the
under a
oil?
whole
Everyone
other
else said,
aspect.
not me.
Makers contains 2 systems that we're really just going to focus on the one. The difference between the 2 systems is that ADS, the alternative depreciation system, generally provides for a longer recovery period and less accelerated. Unless specifically required by law to use ADS or elect it, or GDS is generally used to figure the general depreciation deduction.
Unless it's by law, please don't talk your clients into ADS. Just use the GDS.
Otherwise, it's just a pain.
I didn't
Yes.
even talk to him about it. I just
No,
Choose
just
it
go
and
with
move
it.
on.
Yeah, I just go with GDS unless the system comes back and says, no, you have to use ADS. Then
Yeah.
I switch it over and I explain to my client, because of tax law, we have to use this system instead of this system, so it's going to be a little slower.
Right. You must choose the depreciation method in the first year the property is placed in service and use it throughout the depreciable life of the property.
Yeah.
Once you start, you can't stop.
No flip-flopping. They no like.
Yeah, and you can't change. Choose the right one. You gotta jump through a lot of hoops to change it. There are special forms that you can file with the IRS to make adjustments, but yeah, I don't recommend that.
No. It's kind of like mileage
yeah.
that you learned about
You have to start
Wednesday.
with one.
No, we
and-
really don't cover mileage in that part.
No,
We don't?
no, we
it's,
don't.
it's a future chapter.
Okay. Never mind.
In addition to the depreciation method, you need to know the following information about your property to those makers tables. Basis. How much did I pay for it to get it going?
Too damn much.
Property class and recovery period, the date it was placed in service. We already talked about how that one is important, and the convention to use. Well, we've already talked about a little bit of all 4 of these aspects of it. We've been previewing it.
Mm-hmm.
To figure your depreciation deduction, you must determine the cost or other basis. If you bought the property, the basis is basically what you paid for it. The cost of the property is the amount you paid for the property plus any sales tax, freight charges, installation costs, and any improvements that had to be done, modifications, for instance. Didn't quite fit in there. So to make it better, I had to expand the shed that it was going into. I could include that in setup cost. Could. Might not be my best choice, but I could. The cost basis for real property includes certain settlement costs. I want to see that statement from the title company. I want to see that breakdown of expenses.
Yeah, when they buy a brand new building,
Or
I don't-
sell it.
or sell it, I don't want to see. I don't want to just see this as the bill of sale. I want to see the packet from the realtor that shows this is what the property was worth, this is what the building is cost was, this is what her commission was, this is what the sales tax was, this is what the real estate was, this is what the county tax. I want all that.
Yeah, I want to know what the inspection fee was.
Yeah.
The title research fee. I want to know all that because it goes into basis. I want to know who paid it. Because it's important. Ruby bought a computer system for use in her business. The price of that system was $28,000. That's a serious computer system.
Boy.
Sales tax of $1,400, shipping charge of $130. Your basis is $29,530. That's what we're depreciating over the next 5 years. Because computers are 5-year property. Actually,
Yeah,
we're
this is
depreciating over
actually
6, but I'll come back to that.
Freaking $40.
Depending on how you acquire the property, whether by purchase, gift, inheritance, its tax basis might be different. For example, your basis other than cost if you acquire the property as inheritance. In this case, the basis is usually the fair market value at the time the property was inherited on the date of the death of the decedent, or there is an alternative that you can use at the day of the date that you actually took financial control over.
What's this new charge?
What?
The new inheritance charge, that if you can't pay for the inheritance charge of your parents' home, probate takes it, sells it, and you don't get nothing. Is that
Is
real?
that a state thing?
That's not real at this time. You hear things about that. It's something that some people want to put into place to stop this, what they consider bad. But
As it stands right now, the IRS says on inheritance, whether it's cash, property,
whatever.
whatever, if you have less than $1,013,000 in inheritance, you don't owe any taxes on any of that. It's all free.
Yeah.
There's no tax on any of it, as long as it's less than $1,013,000, which for most of us is
Covers everything.
where we're going to fall. You know, even if you get mom and dad's house and mom and dad's car and the bank account and whatever, all of that is going to fall under that $1 million. So none of it is taxed. What the government wants to do is put out a straight line inheritance tax. If your inheritance, cash, property, and everything else is worth $750,000, they want you to pay X percent of that as a tax for inheriting all that money. Because this is where they're losing is you get mom and dad's home. Mom and dad's home's worth $400,000, right? So if you hang on to that home for 3 years, live in that home for 3 years, and you turn around and sell that home for $600,000,
You have no taxable.
you have no tax on that $600,000 capital gain you just got,
because you're going to exempt it.
because it's an inherited property, so you didn't owe anything when you got it. You kept it long enough to claim it as a primary residence, and when you sold it, you got the exemption for being single. And that's what the federal government's trying to get around with this inheritance thing.
Not that it has anything to do with depreciation.
Well, I didn't understand.
You're hearing a lot of rumor mills.
Yes.
Well, yeah, that exactly, and
I see no immediate threat of that happening in the next 2 years at the earliest.
Yeah. No.
If you change an item of personal use property to business, the depreciable basis is less than the fair market value of the date of the change, or your original cost basis acquired for the improvement, and certain tax deductions. This adjusted basis includes for improvements and decreases for any deductible casualty, losses, or depreciation claimed while the property was used for personal purposes. Kind of a spin on what Matt was talking about, and something that I mentioned earlier. I had a rental property that I decided to move into, so I've changed it. Or in this case, let's put it the other way around. I'm going to rent out the property that I was living in and moved out of. So I'm changing it from personal use to an asset to my rental company.
My daughter just did that.
What's my basis? Well, it's one of two things. It's either the fair market value of what that property is right now, or what I paid for it back when I moved in, whichever's less.
Well,
The lesser of the fair market value on the date of the change or your original cost. That's my basis. I'm going to start depreciating my new property.
so if I bought a house, lived in it for 15 years, made substantial improvements to the house, kept it, bought another new house as a primary residence, and put my old house on the market as a rental, I don't get credit for any of the improvements?
The lesser of the two. Now the fair market value has gone up,
Exactly. So
but
I
my
could,
cost basis hasn't changed, has it? My original cost basis. What are they trying to do here? They're trying to get it so that when you sell that property, that you have capital gain on it. This is
So-
going to hurt you when you go to sell that property because you're going to have a bigger capital gain.
yeah.
That's what they're trying to do. We'll get you later. We'll catch you later. Which is kind of what happened to my guy. Still working on it. Jeffrey owns a delivery business. He purchased a van to assist him with delivery of his items, but he also uses the van for personal errands. Jeffrey could depreciate the cost of the van based on his business use. You better keep a log for this one.
Yes.
He's figured out 60% of the mileage that he uses in the van is for business use. He can use 60% of the cost of his van for the basis of depreciation if he's using actual expenses. If he's using mileage, then this is all off. He can't depreciate it. It's something we haven't talked about yet. That's a future chapter. But if he's using actual expenses, he can depreciate it. But do keep this in mind. There are some caveats coming up.
Yes.
Under makers, property is assigned to one of 9 property classes. These classes establish the recovery period. The number of years over which you recover the basis of your property. The shorter recovery your period, the sooner you recover your cost of your property. The bigger your deduction. Three-year property. Tractor units for over-the-road use. That's that Peterbilt, that Kenworth you see driving down the road.
Heavy highway tractors.
Any racehorse over 2 years old when placed in service. Not really a problem around here. Any horse other than a racehorse over 12 years old at the time it's placed in service. Old Bessie out there pulling the plow. She's a 3-year property.
She probably ain't gonna last 3 years.
Well, it's there. Any qualified rent-to-own property. Yeah, well. 5-year property. Automobiles, taxis, buses, trucks. Any qualified technological equipment. Printers, scanners, monitors, computers,
Office machinery.
office machinery, fax machines, mice, keyboards.
We have mice.
Monitors. Yeah. 5 of them in the office.
We have 6.
6?
We got a few in the back in a box.
Yep.
Oh, okay.
So we have more than that.
They might be dead. I haven't fed them lately.
Yeah. Office machinery such as printers, calculators, and copiers. That simple calculator is a 3-year property. I paid 99 cents for it. Am I going to depreciate it over the next 5 years? No, I'm going to take special on it. But
There are some things that you want to take. You want to go ahead and give bonus depreciation and 179 depreciation on if it qualifies, because it at that point it's
Yeah,
not going to
makes
make a
sense.
whole lot of difference.
yeah, I'm going to depreciate that $1.98 calculator over the next 5 years. My depreciation deduction is pennies.
Right.
It's not worth it.
So you just depreciate the whole thing, or do like some of us and just
Put it under supplies.
call it a supply and a business expense.
And I'm not expecting it to last year. I expect it to fall on the floor and my fat ass to step on it.
Yeah.
Tools for construction industry, general building and specialty trades. Go out and buy a hammer, it's a 5-year property. Okay, maybe I'm not doing that. Go out and buy a power saw. That's also a 5-year property. And that's also going to include the stuff that it takes to get to go running. So I bought the battery operator, bought the DeWalt with the battery pack. And I have to buy new batteries for it. That's a new 5-year property. Any property used in research and experimentation, appliances, carpets, furniture, etc., used in a residential real estate activity. It goes back to the old clients moved out, the carpet needs to be replaced. I put in new carpet, I'm going to depreciate it over the next 5 years.
Yep. Also applies to that hot water heater.
Anything that's involved with the house. If you have washer dryer in the rental property that stays with the rental property and the dryer goes out, you replace it, you're depreciating over the next 5 years.
Dishwasher.
Dishwasher, same story. Garbage disposal.
Refrigerator.
Yeah, the fridge. As long as it stays with the house, as soon as you replace it, it's a 5-year property.
Yep.
That's here. Certain geothermal, solar, and wind energy properties, breeding cattle and dairy cattle. Yeah, it's kind of scary what you have to depreciate. I hated doing Purity Springs.
Well, luckily, we haven't had very many
Farms.
Schedule Fs, so
Any machinery equipment other than any grain bin, cotton gin, asset, fence, or other land improvements used in a farming business and placed in service after 2017. Go out and buy that new combine. It's 5-year property.
that's why we say with certain returns, like an owner-operator for a truck driver or a farmer, if you think about it, truck driver goes out and spends $200,000 on a brand new truck. He's going to depreciate that over 4 years. That's $50,000 a year, basically, for the next 4 years that he gets to take off of his tax return. Same thing with the farmer. The farmer goes out and spends $400,000 on a brand new combine. He's going to get $80,000 a year average or better
On expenses.
on expenses for that one piece of machinery. So he might have money in the bank, but his taxes are going to show that he's not making a cent because he's depreciating a $500,000 piece of machinery.
Well, and we've got to look at it from two different points of view too, because not only did my guy buy a truck, highway tractor, bought the trailer to go with it. That's its own depreciable asset.
Yeah, and not a 3-year. It's 5 year.
Yeah, the trailer is 5 years. So the farmer went out and bought a tractor, and then he bought the little grain thing that he pulls behind it that the combine dumps it into, so he can,
It's belly dump.
so he can keep on going. Well, I was thinking about the one that's attached to the tractor that is the go between the combine and the truck.
Yeah, it's a belly dump trailer. Once you put it in there, it's got a
Now it's got the auger that pumps it out and puts it in the belly dump. I'm talking about the grain bin that behind the tractor.
right.
Yeah, that's still called a belly dump, even if the auger is the one that's emptying it.
Bumps out of the belly, doesn't it?
How do I get it above the trailer?
The combine?
No, the combine empties into the bin that's on the 2 wheels behind the tractor.
Oh, okay, yeah.
You know what I'm talking
Yeah,
about now.
okay, yeah, never mind. Yeah,
Different thing, same idea.
Yes.
Still a trailer.
yeah. Yeah.
Office furniture is a 7-year property. The desk, this table, that chair. All depreciated 7 years ago. Actually, let's change that around.
Depreciated 25 years.
Well, no. When Brett bought it, guess what?
Oh, it restarted.
It started over.
So he's still got 2 years on
You still got 2 years left on the chair that you're sitting on.
to get to depreciate that stuff, even though we may have bought our own and brought them in.
Only if you returned in the receipt.
Yeah, I never did.
No, because when you leave, you're gonna probably take it with you.
Damn Skippy.
Well, it's just like when my grandfather passed away.
Yeah.
The depreciation for the property that my grandfather owned that went to my dad
Starting over.
started over. And my dad called me, he's like, what is this depreciation for the property in Phoenix? I'm like, okay, what about it? I'm like, well, my guy's depreciating it. Your grandfather already depreciated it. I'm like, yes, but it's now your property, not grandpa's. You get to depreciate it.
You get to start over
Again?
either one.
I'm like, yes, because now you own a property worth X dollars. It's commercial. You're leasing it. The depreciation of that property is part of your rental expenses. Are you sure?
No.
No, I only do this job as a,
I told him,
Railroad track is a 7-year property.
I told him, I said, let me ask Shane, but I'm sure.
Railroad track.
Yeah, railroad track.
Yes.
Remember when I said that there is a certain class life and you can't figure out where it goes there, it goes here. It's a 7-year. You can't figure out what it is, it's 7 years.
We wouldn't have somebody coming in and owning a railroad track.
That's not necessarily true.
How we explain it?
They own the
Portion,
siding.
I could see a portion, but not a.
They put a siding in.
a what?
A siding. Alright, so you got the main line track and then you've got it where it comes off.
Okay,
It
so
may dead end or it may reconnect to the track at the other end.
like
but-
Cornejo, they have it where it comes
Right.
in. Right.
That's Cornejo. They put it in.
Okay, yeah.
They're
Okay, I get you
depreciating
now.
that
Okay.
because it's their track.
Okay.
It's not the
But
Cano's
you're not
track.
going to usually see an individual
Generally, no.
that has that.
But Cornejo or whatever,
A
it's
business,
Pearson.
yes.
Pearson's now.
Yeah,
They started
Pearson.
over.
Right, yeah.
So Pearson's is depreciating that amount of track.
Right.
Because it belongs to the property, not to the K&O.
Yeah, okay.
Now the track
Understand
leading
that.
up to it belongs to the K&O, and then the track leading up to that belongs to Burlington Northern, Santa Fe.
Right.
So you can see all the different parts. No, don't think about the track between here and Kansas City. Yeah. Burlington Northern's already depreciated that, except for the repairs that they, or any, not repairs, but if they put in new timbers, they've changed the life of it. They put in new ties. That reset it. Changed the useful life of the track. Ten-year property, vessels, barges, tugs, and then water transportation equipment. Well, that's not really a problem around here. Any single-purpose agricultural or horticultural structure is a 10-year property. Now, a barn really isn't a single purpose.
What a greenhouse
A
is.
greenhouse is. The chicken coop is.
I don't know, you could grow mushrooms
I was
in your
going to say,
chicken coop.
what if you have more than one type of livestock in that chicken coop? Do you just count them all as fowl?
It depends on what I'm going to.
I mean, if I have turkey, chickens, and quail all in one,
It's the bird coop.
okay,
Moving
Yeah.
on.
okay,
It's
that's,
fowl.
That's what I'm asking.
It's a foul. It's a foul-smelling foul building. Now, if I have a cow in there, I'm back to barn.
You're a bobcat, you just did it.
Only for a short time.
Yeah, and I'm not going to worry about the fact that the cat, goes in there to sleep at night. I'm not worried about that. It's not the cat house. That's here. Any tree or vine bearing fruit or nuts is a 10-year property.
All
It's
of
not
Napa
exactly the
Valley.
greatest example anymore, but back in the day, you go down to Blood Orchard there in Hayesville, those peach trees are 10-year properties, each and every one of them.
Napa Valley.
Yeah, Napa Valley, the grapes vines are 10-year properties.
Uh-oh. Adrian Peterson was arrested.
Well, keep up for him.
Who's that?
I used to be a running back.
Running back in the NFL.
What's his name?
15-year property includes certain improvements made directly to land or added to it, such as shrubbery, fences, roads, sidewalks, bridges. Again, I can't do anything about the land. The land is land. I can't depreciate the land. But if I make an improvement to it, I can depreciate the cost of that. So even if I go up and say, okay, I put in a lake,
15-year.
15-year property.
Put in a roadway to get to the lake.
That's its own 15-year property.
Now, does the road have to be paved or can it be
It can be gravel. It can be
gravel. It could be just as simple as the guy in the dump. The guy in the dump truck came out on a pretty good. It's been dry for a long time. He just backs it up and drops the load as he goes.
Mm-hmm.
I've always been envious of those guys. Man, they are good.
Yeah.
It's fun to do.
Yeah. He's just backing it up and he's laying his own road as he backs
Yep,
up
yep.
and dumping it.
Yep.
That takes some skill.
Yep.
Let's see here. Open a convenience store. Hey, well, at least some of the property's 15 years, not all of it. Put in the gas pumps, the awning over the gas pumps, the lights. So I'm not worried about municipal water. Initial clearing and grading the land improvements for a gas utility. No, not a problem. Electric lines, no. Gas, no. Distribution, no. Okay, so some of these things you'll never touch. 20-year property, farm building, other than single-purpose agricultural or horticultural structures, which are already covered.
Barn.
The barn, technically the farmer's house, could fall under this.
I wouldn't recommend it.
I don't
but
recommend it, but it could fall into this area. Depends on what he's
Would
doing.
his main office count in
Well,
there?
that's home.
He could use a
That would
business
be
home.
use of office.
He could be used a business home. But let's take it farther. Let's say that, the wife is really into canning. And there's a whole bunch of room down in the basement full of canned goods. Storage. Maybe she's selling them. Goes out to the farmer's market.
I would still be tempted to call it business use of the home.
I would too, but, and I'm never going to hear this argument, but I'm just saying.
Yeah.
There is a roadway, but you really have to justify it. 25 year. Don't care. Residential rental property. This includes real property such as a rental home or structure, including a mobile home, if 80% or more of its gross rental income from the tax year was from its dwelling units. A dwelling unit is a house or an apartment used to provide living accommodations in a building or a structure. It does not include a unit in a hotel, motel, inn, or other establishments. More than half the units are used on a transient basis.
That's just rental property.
That's business property.
Business property. Real property.
If they occupy any part of the building and structure for personal use, its gross rental income includes the fair market value of the part they occupy. For residential rental property placed in service after 86, the recovery period is 27 and a half years.
So when you were asking about the people that own the hotel and they have their apartment, their living house there in the office area, if fair market value of an apartment rental is $650 a month, technically they have to add 650 times 12 to their rental income.
Yeah, but under depreciation, what we're talking about here is that whole hotel is not, even though people are renting it to live in it for a temporary basis, it's not a residential rental property. It is a business property that's going to be the 37.
So these old ladies that are living on cruise ships now, how do they do theirs? You think they still have a base home?
Generally, no.
No, but that would be more of a, at that point, it would be more of a personal property issue, and you're not. I mean, if you're 68 years old and you go from cruise ship to cruise ship to cruise ship to cruise ship to cruise ship,
Garbage truck.
and that's all you're doing, it's no different than if
I
you
know.
were
I'm sitting
paying
here
a
looking
monthly
But
rent
that door and that door is
at a
not shut
place.
right.
It's the,
Is there something
it
stuck
would
in
fall
it?
more under personal property than it would
Piece of plywood.
uh, rental. It's not like you own the cruise ship and you're renting out all of the staterooms on the cruise ship.
Well, and your bigger problem is that on top of that, the cruise ship is most likely not flagged in the United States, so it's subject to whatever the rules are in that country.
That's possible too.
You have to go by the origin of the ship then?
Whether
Even
it's
though
flagged
you're
in.
in international waters?
Whatever the flag country is. Until it sinks, then you don't have to worry about it. It
Yeah,
sinks
that's
in.
why I won't take a cruise. Which is why I like that song of the bridge would sing.
I've been on cruises.
Poseidon man. No.
Ooh, God. Anyway, so rental, landlord. This is your landlord. This is your Schedule E guy. He buys a house this year. I'm setting it up. I'm going to depreciate the $100,000 he spent to buy the house over the next 27 and a half years.
Yep.
Non-residential real property. This includes Section 1250 property, such as an office building, store, warehouse, which neither of the following. It's not a residential rental property. Not a property with class life of fewer than 27 and a half. The recovery period for this, so this office, for example, the strip mall, I should say, 39 years. The lady who owns this, she bought it, what, 3 years ago? No, 5 years ago. She bought it the COVID year.
2020?
Yeah.
Okay.
That's when, yeah.
Yeah.
So she's 5 years into 39 years of depreciating the strip mall. The landlord is actually the owner of the franchise Pokimoto. So if you ever need to talk to her, she works first shift, so you just go in there and talk to her.
Oh, the lady who owns the.
Yeah.
She does Pokimoto too?
Yeah. Well, her rent is cheap, isn't it?
Yes.
Yeah, and I just go over. By the way, if you wear a Liberty shirt, you go in there and order food, you get a discount.
You know, like raw fish?
You don't have to get raw fish.
Seafood salad.
Actually, I like their bubble tea. So, in 2016, Will Margaret bought a house to be used as residential rental property for $80,000. That includes $10,000 for land value. They began depreciating the $70,000 building cost basis in 2016 over the recovery period of 27 and a half years. 24, they completely replaced the roof, costing them $7,000. The new roof is a component of the building. In 24, they will start depreciating the $7,000 cost of the roof over 27 and a half years.
And then they just add that to the original 70.
No, it's its own
No.
property.
It's its own depreciation.
Until it's fully depreciated or the next hailstorm wipes it out, whichever comes first.
Right.
And then we start over again.
Oh, yeah.
So basically, 8 years after they're done depreciating the house, they will be done depreciating the roof.
Assuming that they didn't have to replace the roof again.
Again, yes.
This is Kansas, that's a big assumption. But here's an interesting example that I never thought about this until I was just saying it. Shannon's client, the one in Augusta with the house that's a greenhouse, that's not a 27 and a half year property, even though it's a house.
No, it's 15.
No,
It's a single-use agriculture. The greenhouse is
Maybe, but she's using it as a commercial. I could make the
Commercial
argument.
office or business.
I could make the argument this should be a 39-year property too. I see yours, and I never thought about it until you said it, but that is in play.
I mean, if she's if
If
she's
it's
using,
exclusive to the greenhouse only.
right, if she was using it, if she's a horticulturist or whatever, she flowers, whatever, and that's what she's doing in that greenhouse,
Yeah.
I would say it's a single-use agricultural,
Yeah.
and do it at 15.
Yeah, I can see that argument. I'd actually almost have to go there
And
you know,
look at it and see what's.
It's long.
I know, but
I haven't seen her in years.
that's an interesting case. I mean, we've talked about that, so I never really thought from that point of view. It's not a house by any stretch.
No, it's not a house.
Dude, it was hard to convince corporate of that.
Well, I don't know why, because you know, you think
Remember,
about.
we did. It took us
I
forever.
know, I remember that, but think about this: is that
Oh, is that lady that was doing the breads and the?
No.
Oh, okay.
No.
But
You're
you
thinking
think-
of Brenda's client.
you think about it, you've seen some of these insurance agents that converted an old house
To an office.
on
There's
a main
one right
street.
here.
Yeah, there's a few just down
Yeah,
Seneca here,
yeah.
where they took a house and converted it into an
It's
office.
an insurance.
And then the ladies across the street turned that house into a salon.
Yeah.
Yep.
That's not a house anymore. It's a business property. They're not going to depreciate it at 27 and a half years. They're going to depreciate it at 39.
You got your palm reader down there.
Um,
That's the way.
When an improvement is made to a unit property or related demolition or removal of a portion of the underlying property occurs. This allows me to take a partial disposition of a portion of underlying property replaced with the improvement. If the property is classified in the same maker's asset as the disposed of property. So I could, if I'm replacing that roof, I could take a partial disposition if I have to replace the roof again. Helps offset some of the capital transaction that I'm dealing with. Conventions establish standard for when the recovery period begins and ends. Convention you use determines the number of months for which you can claim a depreciation deduction in its first and last years of property in use. Makers has 3 conventions: the mid-month, the mid-quarter, and half-year. Depends on when I put it into use and what type of property it actually is. Which convention you use depends on whether the property used in real or personal. And if personal, how much of the property was purchased in the last 3 months of the tax year. Again, don't get hung up on the word personal,
Yeah.
because in this case, the word personal implies that it's personal to the business. Choose the appropriate makers table based on class and convention pairing. For each real property, residential and non-residential, so house or office, mid-month. Under this convention, all properties being placed into service or disposed of in the middle of the month for which you begin or end use of the property. It doesn't matter whether I bought it in January or December. I'm going to start depreciating it is on January 15th or December 15th. And this is actually part of the depreciation schedule.
Yeah.
Again, I'm only filling out this section when I'm starting something. If I'm starting to depreciate a new asset that the guy bought this year, this is the only time I'm in this area. You didn't buy anything this year, I'm not touching it.
Yep.
I don't need to. But down here we can see that we have a residential property or a non-residential property. Setting it up over 27 and a half or 39 years under mid-month. And that also says we're using straight line. Basically, it's the same percent every year for the next 37 years. 39 years.
They basically take that $200,000, divide it by 39, and that's what you get every year.
Basically, yeah. So, I mean, the thing is that when you look at this table, this happens to be for the rental house, you can see that in the first year, it does depend on what month I start and how much depreciation I get to take.
Yep.
It also depends on what month I finish in to figure out what the depreciation I can take. That's the only time that it's different because of allowing for the change of where I am at in the calendar year. After that, the only difference is a rounding error. 3.636 or 3.637. And it's just alternating back and forth between those two numbers to make up for the rounding. All of those years, it's the same percent per month. Except for the first and the last year. So in June, Chris Brown purchased a residential rental property for $500,000. Land included in this is $75,000. Can't depreciate land, so we're depreciating $425,000.
Right.
Because this is a residential rental property, recovery period is 27.5 years. Mid-month convention is used. He's going to use that table A6. List price of the property and service in June of 2024. So he looks under column 6. 6 months. Year 1. Depreciation percentage rate for the first year under June is 1.97%. His depreciation deduction on the $425,000 that he's using as basis is $8,372. Figures depreciation deduction for 25. He simply uses the year 2 percentage under the column 6. 425 times 0.03636. Next year he's going to depreciate $15,453. And that's going to be that number for the next 29 or 27 years. That's a fixed cost to him. He can count on it. Does that mean he spent it? No. This is why I said there's a difference between tax books and bank books. They're going to be different. Half-year and mid-quarter conventions are used for personal property. The desk, the computer, that's personal property. Convention for personal property is determined annually, and once determined will apply to all assets that are 3, 5, 7, 10, 15, and 20-year class life. So the 25 was straight line, actually.
Yeah. 25, 27 and a half, 39 are all straight line properties. Or straight line
You're right, it was
depreciation.
40%.
Is it 40%?
If the depreciable basis of the property placed in service in the last 3 months exceeds 40% of all the total depreciable basis of all property placed in service throughout the year, you have to use the mid-quarter convention.
Right.
We are not going to reward you for waiting to the last quarter of the year to buy everything. Doesn't mean I can't buy things. Just try to avoid buying more than 40% of your stuff. And wait till quarter 1 next year.
Yeah, but is that normal when they run all the big sales, Black
Yes.
Friday
Sure.
and all that?
Not necessarily.
Assuming that you're using a calendar year as your fiscal
I was
basis.
gonna say, yeah, because some companies, they may, their fiscal year may go June to June.
When I worked at the nursery, you didn't want to run on a calendar year because your first quarter would always suck
Because of winter.
because it's winter. And nobody's buying squat except for the marijuana growers. They're coming in buying the seed trays and the potting soil and the grow lights. And we don't ask questions of that. But first quarter sucked. So what was their calendar year? Or their fiscal year? Fiscal year was September 1st to August 31st. That way, because fourth quarter not terrible, because people are still buying plants in the fall. It's actually a good time to plant your plants because the root system grows all winter without having to worry about what's up on top.
So your first quarter's not bad.
Your first quarter's not bad. Your second quarter sucks. Third quarter's outstanding because it's springtime. And then fourth quarter's Just depends on how hot it was, how long.
And when you're setting up your business, you can choose that first year that you file your business return, you can choose how you want to figure your taxes, whether you want to go on a calendar year or whether you want to go on a fiscal year. Catch is once you start,
You can't stop.
you can't stop. So if you come in and you're running a landscaping business, and you come in that first year and you say, look, I just started a landscaping business last year. I'd like my fiscal year to run September to August. Perfect, we can do that. That's not a problem. But in 2 years, he doesn't like the way that's working and he wants to switch back to a calendar year, January through December. Then we've got to
Well, there's
petition.
Yeah, you can petition the IRS for a change in accounting systems, and that's fine. Most of the time, they'll accept it. Or this is most likely what happened because I am sure that the guy who established the business in 1952 was not using that fiscal year; he was using a calendar year. So, I bet he changed his accounting system when he went into the partnership and gave his children all a share. So it went from a sole proprietor to a partnership that gives him an opportunity to reset his accounting system.
Exactly.
I bet that's when he changed from calendar to fiscal, is when the children are old enough to be participatory factors in the business. So a half-year convention is the normal one. Use half-year convention for all property type unless we are forced to use quarter. Under half-year convention, the property is treated as having placed in service or disposed of at the midpoint of the year, no matter when you got it. And this is our table for that. The 3-year, 5-year, 7, 10, 15, 20-year properties. And you can see that the first year is basically kind of a half. I mean, because look at the third year, just keep it simple, that's 33.33%. But the next year, when you get a full year of it, it's 44%.
Yeah, so think about your truck driver who spent $200,000 on a truck, and his first year, his depreciation on that truck, $68,000. His next year is $120,000.
And in 2 years, he's already depreciated 75% of it, roughly.
But when you're looking at something like that, if his second year he's out, he makes $250,000. By the time you put in his depreciation for the truck for the second year,
He made no money.
and his fuel, you've already accounted for well over $200,000 of his $250,000 income. Now that doesn't mean he spent that, but that's what he's getting credit for.
Mm-hmm. It's a paper loss. Theoretically.
Yeah, theoretically. And the IRS knows, okay, so for the last 4 years, you bought a brand new truck, last 4 years, you've posted a net operating loss. Maybe a little net profit in the last year since you're only going to get about 8% left over at the last half of the year.
Assuming you didn't blow your engine and have to start over again.
Right, well, in 4 years, you're looking at, on the average truck driver, you're looking at somewhere between 650 and 800,000 miles on it. So it's ready for an in-frame.
Yeah.
But what a lot of guys do is, at the end of that 4th year, instead of going out and spending $30,000 for an in-frame rebuild on the engine, they turn around and they take that truck and they go trade it in and buy another new truck and start a whole new 4 years. So every 4 years, this driver's buying a brand new truck. And the 4th year of every 4-year block, he's showing a little net profit because he's down to 8% for depreciation on the truck. So when he goes to buy something and he says, I need my taxes, and he's showing 3 out of every 4 years as a net operating loss, he could have $500,000 in the bank.
Yeah.
I've got the money in the bank to cover my loan, but his taxes, which is what the bank's going to go off of, going to go, you're not making any money. We
Yeah.
can't loan you any money.
Yep. Because that's what they want base off of. And he's in trouble. Now, this I've been waiting to do this, but all right. So 3-year property. There's 4 numbers up here. Why? Because we're starting at the half point of the year. So the first year is 1/2 of a year. Therefore, to get 100%, I have to do half of the last year. So year number 4, even though I'm on a 3-year property, is the other half of the first year. And yes, if you add up all those percentage, guess what your number is going to be?
100%.
100. So that last year is basically the leftovers.
The last little bit.
Layla is furnishing her new office. February, she purchased office furniture for $2,000, computer for $5. 100% for business, tangible property. She's using Makers. Office furniture $7, computers $5. Determines the convention. None of the property was purchased during the last quarter. She can use half year. Furniture is 7-year property, so her deduction is $286. That's the $2,000 basis times 14.29%. Computer equipment is a 5-year property. Using the 5-year table, that's taking $1,000, or is $1,000 expense. That's 20% of the $5,000 she spent to buy computer stuff.
Yep.
This is what my depreciation form looks like for that year and that year only. I'm telling the IRS when I bought it, how much it costs, how long it's going to be on the books. And this is the last time this form is going to show up for those things. From here on out, it's a worksheet. The IRS will never see. Because the IRS doesn't want worksheets.
Nope.
They already know.
You filed it the first year. After that, it's just going to show on your 1040 that you had X
Yep.
for depreciation. Thank you very much. And on down the road they go.
Yep. And the IRS is expecting it. So like I said, how many ever classes of property I have on that first year is how many ever lines I'm taking. She only had the 2 classes. Well, if she was an owner-operator, she might have a 3rd class up there if she bought a truck. Mighty Bays brought a filing cabinet in May of 21 and 24. The filing cabinets are in year 4 of the recovery period, not 3. The correct percentage under the table for 7 years is 12.49, not 17.49. Remember, always pay attention to what year that you're in because that last year makes a difference. The last year is always going to be a lower number. Well, actually, you start at a bigger number and you work your way down.
Yeah, don't just subtract. You put it on in 21, it's now 24. That doesn't mean you're on year 3. You can't subtract.
Yeah.
Because you have to count year 1 as 1.
Mm-hmm. As a full year, even though it wasn't.
Right.
Mid-quarter must be used when the depreciable basis of the personal property placed in service during the last 3 months, the last quarter of the year, is more than 40% of the total of all depreciable basis and property placed in service during the entire year. Don't worry about stuff that I bought and sold in the same year, because I'm not depreciating it anyway. For determining whether the mid-quarter convention applies, the depreciable basis of property placed in service during the tax year reflects the reduction in basis for amounts expensed under 179, which we haven't talked about yet, and part of the basis used property attributed to personal use. There are some things that I can buy that I'm only depreciating a portion of it because I'm also using it for my own use.
Laptop. I use half for business here, the rest of it at home. And actually, that's not even true.
No.
I only pull it out when I need to work on a customer. So, but yeah, that's a prime example right there.
Yep.
Under this convention, the mid-quarter treat all property placed in service or disposed of at any quarter of the tax year is placed in service or disposed of at the midpoint of that quarter. You receive partial depreciation deduction for the first and last quarters. Enter MQ on the 4562. If you're required to use the mid-quarter convention, you must use mid-quarter convention for all personal property placed in service during the entire year. Obviously, since we're breaking it down into quarters, there are 4 different tables with 4 different sets of numbers for the 4 different categories. But this only comes into play when 40% of my total expenses are in the 4th quarter.
And that doesn't mean everything goes off of the fourth quarter chart.
No.
It just means you have to break down what you bought January, February, March. That's one quarter. April, May, June's another quarter. So everything that you bought during that 3-month block is mid-quarter for
And-
that quarter block.
And you're not really worried about it because as I'm putting into the computer, what's one of the questions it's asking me? Date, placed, in service.
Yep.
It's already going to figure that out for me. It's already going to figure out that 40% was bought in 4th quarter. And therefore, from that point on, it's going to go look at all of those and figure out what quarter it belongs into.
Yep. All we're going to do is tell it the convention and the life and when it was placed in service.
Yep.
It'll figure everything else out for us.
We psych ourselves out on depreciation sometimes because we want to make it more confusing than it actually is. Shannon's a great example of that. Ricky purchased and placed office furniture and computer equipment in his business in service, totaling $14,000. 7 was purchased in November, so that's half of it. Already, we know we're using mid-quarter conventions.
Yep.
The cost of Richard's purchases exceed the last 3 months of the 40%. The total cost of property placed in service throughout the year. You must use the mid-quarter convention for all personal property placed in service. In this year, the convention established in the first year that's placed in service again. IRS loves consistency. We haven't harped on that a lot, but we have to some point. Once you start something, you better keep up with it. They don't really like midstream changes.
No.
For each piece of property, depreciation convention established in the first year will be the same one that we keep on going. I don't have to worry about stuff that's already on the books, too. That's irrelevant to whatever happened this year. That's going on in the background. It has no effect.
You could have identical properties purchased in different years, and in one year it could be half year convention, and in another year be mid-quarter.
Yeah.
Because the year that you put that property in, you didn't do over 40% in the last quarter, so it qualifies for half year convention.
Right. It's just a little interesting side fact.
Mm-hmm.
Depreciation method determines the amount of percentage of the basis that will be deducted each year. For most used methods of tax purposes, straight line accelerated. Straight line is the total cost divided by the number of years. And we saw what those examples were. They're basically property. Even the 25-year is property. It just happens to be municipal type.
Right.
There, an example up here, $1,000 computer for 5 years, $200 a year, that would be straight line. But that's not what we're using. That's the alternative one.
Yes.
And I don't recommend it either.
No. And neither does the IRS.
Yeah, no. Accelerated depreciation. This is what the IRS actually uses. Because we're taking, my value is taking more of a hit in the first years than it is in the last years. So on double declining basis, the first year deduction is double the straight line. That's what we're using in Makers. There's another one called 150% declining balance. That's 1.5 times the straight line. Again, we're sticking with the DDB. Unless we have to do otherwise. When you apply the convention to the first year and the last year, the amount of depreciation will be reduced. Half-year conventions receive half the depreciation the first year and the other half the last year. That 3-year property is going to depreciate over 4 years. 5-year property is going to be depreciated over 6. Because I got to get that final half year in. Each table incorporates the method in the convention. When you select the correct table for the method and look in the column under the appropriate recovery period, you'll find your depreciation percentage for that year. Like we said, when you add them all up in that column, you get to 100. This is from publication 946. We're not worried about that necessarily because we've already kind of talked about this. This is the depreciation worksheet. This is when I have a new client to me. This is the piece of paper I'm looking for the most.
Yes.
I desperately need this sheet. If you're depreciating property, I need this worksheet. I can't do anything. I will not finish your tax return without having this worksheet. And that's where some places put you over a barrel. They won't include it in your paperwork. We're not one of those places.
No.
But some places do. Oh, you want it? You have to come back and ask for it. Why aren't you coming back to us? You know, just making it uncomfortable for you so you're less inclined to go someplace else. I get it. I don't agree with it, but I get it.
When we print out a copy of the 1040 for a client, we always include all of our worksheets.
All the worksheets are involved. The IRS doesn't get this. They don't want worksheets. They just want forms and schedules.
Right. If we have to paper file one, when you're running through, when you get to that last page, and then it starts going into your worksheets, that's where you stop.
Yeah.
So that last schedule is the last thing you would print off if you were having to have your client paper file.
Right.
Because there won't be an 8879, but it'll go from the schedules and then it'll flow right into all of the worksheets. And where the worksheets start, that's where you stop your print because the client doesn't need that to file.
Yeah. That's for their own personal records in the file cabinet.
Yep.
Anyway, this is telling me what's being depreciated, when it was placed in service, how much was being depreciated already. It tells me where I'm at on those graphs,
Lets me put it in on
those
my
tables.
depreciation schedule.
Yeah. So I have to have this for a new client. Otherwise, it's going to be wrong, and I'm not going to file this return because I know it's wrong. Okay.
Would that cause a reject?
No,
No.
it won't cause a reject. It might cause an audit.
Yeah.
Hey, you were taking depreciation for all these years. What happened? Because according to our records, you still should be depreciating things.
Yeah. You've been depreciating your rental homes for 15 years. This year you didn't depreciate any of them. Why?
So,
But you'd have a sheet saying that.
Right. But you would, if you did that, if you sold all, if last year you went to H&R Block and did your return and then turned around for 2025 and sold all of your rental properties and then came to us and said, hey, look, 2024, I had 15 rental properties, but in 2025, I liquidated all of them and I got out of it, we'd be able to go back in and list all of those properties because you'd have, presumably, hopefully, a 1099R or a 1099S for a capital asset sale.
Yeah.
And we'd be able to put all that in. And then when the IRS gets that, they're like, oh, okay, okay, so these were being depreciated. Now,
Yeah, they're going to be looking for
You're
reasons
sold.
why aren't you depreciated. If you sold it, great. Where's the capital transaction?
right.
It's not saying that I can't stop, but I have to show reason.
Right. If I-
What's a recovery period?
that's
It's
the depreciable life of the property.
27 and a half years, for instance.
Right. So if you have
And there is a point where I might stop, and I'd have to take a pause. Think about this for a second.
yeah.
Rental property. The last tenant trashed it.
So it's off the market.
I can't rent it in this condition. I might have to take it off for a year while I repair it. Well, I can't depreciate it because it's not available to rent.
Yep. And at that point, when you're going through his Schedule E, when you get to that property where it says number of days available for rent, you put 0.
And
So
we'll
now
skip.
they know that rental property was not rented that year, and they won't get any of their expenses or anything else because it wasn't available for rent, and it won't get any depreciation. It'll pause everything.
Mhm.
Doesn't mean he can't use what he's spending to make that property
Inhabitable.
rentable.
Again,
Rentable. He needs to save all those receipts because we can take that and put that on a separate depreciation schedule next year when he puts it back on the market.
Yeah, we have a new escrow account called repairs.
Yes.
That's going to be depreciated over 7 years, I believe.
15, 150 months.
Yeah, okay, yeah.
Because it's an amortization
Yeah, it's an
schedule.
amortization. 15 years. So, there are reasons why you might have a skip.
Right. And as long as you can show it, then you're all right.
Right.
I hate
This
these.
chapter. Special depreciation, and this is kind of what everything wants to default into at the moment, except for the big ticket items.
When you're filling, when you have a depreciable property and you're filling out the depreciation sheet, it will ask you, how much bonus depreciation have you taken? How much 179 depreciation have you taken? If you leave those blank, I don't care if it's for a $200,000 highway heavy use tractor or a $300 office printer, it will automatically figure your bonus and your 179 for all of it and give you all of a sudden you're looking at a $200,000 expense because it's giving you 100% depreciation in the first year for that highway tractor you bought.
There's actually a box you have to click to opt out of special.
You actually have to put in there zeros all the way through.
That too, but there is a box.
Is there?
Yeah.
I have never found it. I just go
It's
through and
buried.
I go through and I put
I
in
know.
zeros for
You're,
everything.
you're doing the same thing. You're doing the same thing that the box does. But there is a checkbox
Okay.
on that form. You can go look for it and
I will
opt.
go. I will go. Look
You can opt out.
Because when you open it up, when you do your depreciation, when you open it up, you will see that those boxes are lined in green, which means it's already figuring it out. So once you put in how much you paid for it, when you put it into service and everything else, all of those boxes are going to be in green because it's already figuring out your depreciation, your bonus, your 179. Unless you go in and you put in a different number in there to stop it.
All right, so bonus and special are basically the same thing. Percentage of the deduction has changed through the years, 100%. Still applies for qualifying property that was acquired and placed in service after September 27th, 2017, before January 1st of 23. After after that, it's 80% until January 1st of 24, and now it's down to 60%. Before all that started, the special depreciation was 50.
Well, I wonder what it's going to be after January 1st.
Actually, was there something?
Because
on
the
this?
60% ended January 1st. So
Hold on. I thought there was something. Let me think about it.
I don't remember seeing anything in OBA. Special bonus depreciation.
After January 20th, 2025, 100% bonus.
So it's back to 100%.
Yep. And according to this, it's permanent. So it'll fully depreciate it unless you tell it not to.
Yes.
And so the other part of this, since I have this in my hot little hand, 179 expensing has raised the limit from 2.5 million to 4. Because there was a limit
Yeah, there was a limit.
on 179, so the limit's now basically
Almost.
almost doubled. Properties considered qualified property means the following. It's tangible property with less than 20-year recovery period. Any computer software that's not readily available for purchase by the public has not been substantially modified. So I can't fully depreciate the fact that I bought Microsoft Office, but I could fully depreciate some proprietary software that I had made for my business. And it also could be new property, which is really what you kind of think of for the most part when you talk about this type of stuff. But it could also be used property. You buy something out. Oh, well, Brett bought this place from corporate. Box, stock, and barrel. Everything was already here. But he starts depreciating it. Again. Because the previous owner, hell, he depreciated all. He had it already all depreciated. He owned the business for 10 years. Well, he considered it a 5-year property.
Bob was 10 years.
Yeah, but you also have to figure too, when Brett bought this from corporate, the price of the price of the office included
Everything.
everything in here. So the computers, the chairs, the desks,
So
all
it
of
wasn't
this.
broke down.
Right, it wasn't necessarily broke down. It might have been
Yeah.
on his sheets, you
Might
know.
have been itemized.
Yeah,
but
might have been itemized in the sale.
I remember filling out that paperwork.
So like an inventory.
I had to inventory everything for corporate before that. Corporate already had it broke down. They knew how many computers, how many monitors. They knew all those little components that were in here. Well, that was before they sold it because they just took over. They had to depreciate it. So I don't know whether they passed that information on to Brett or not. But I remember filling out that worksheet for corporate. So they could have passed it on to him. He could break it down.
Yeah.
There was an out for him to be able to break it down, because I know the worksheet existed. So that was fun. I forgot all about that until you just mentioned it. It's like, oh yeah, I remember that. I filled that out. So yeah, when you're franchised with Liberty, you sign up for 5. So Brett just re-upped. He's committed to Liberty until 2030.
We worked for Brett for 5 years.
Yep.
Yeah, because he bought it in the COVID year. Because Bob retired
Yep.
in the COVID year. He left just in time.
Bob retired May or June?
May.
May 1st
I thought
of
it was
20.
April 15th. and
No,
that
no,
last day
no,
he was
no,
done.
no. It's May.
May 1st of 2020, Bob retired. It went to corporate. Corporate kept it until October 2nd of 2020 when Brett bought it.
At a fire sale price, I might add.
Yes.
Because corporate doesn't want corporate stores.
What's up?
Basically, they said, look, rock
Do
bottom
this,
minimum,
we'll do
this franchise is worth $60,000. That's what I'll sell it to you for. If you buy these other 3 offices, I'll give you 3 offices for $150,000. if you buy all three. Even though each office might have been worth, let's say this one's worth, 80,000, and Rock Road would have been worth 75, and Broadway would have been worth 25. Separately added together, they might have been worth, say, 200. Corporate doesn't want them. We'll give it to you for 150, and
Please
then
take them off our hands.
and then take our franchise fee.
Yeah.
We'll get that other what it was worth. We'll get that on the back end through your franchise fees for the next 5 years.
Although they actually did discount the franchise fees too.
Yeah, but
That was part of the fire sale.
yeah, but even still, even with the discounted franchise
Oh, yeah.
fee,
Oh yeah.
they were making it up on the back end.
Let's see here. I don't know that I really need to talk about that. I'm not, so I'm not going to. You can elect out for any class property not to deduct the special allowance from all property we placed in service that year. See, that's the unfortunate thing. Either you're all in or you're all out.
Yep.
I can't decide that, well, I'm going to special depreciate those two computers, but I'm going to take regular on those two computers. Either all in or you're all out.
If you special depreciate one class, the entire class is special depreciated.
Now, I can choose to special depreciate the desks and regularly depreciate the computers. Those are two different classes.
Yeah.
And that's basically that entire
Example.
yeah. Well, I've got to speed up just a bit. We're already down to 35 minutes left of class.
Okay.
You were always wondering, well, which class was it that goes over it? It's this one. There's a lot in it.
Yeah.
It almost needs 2 days, just like Schedule C does. Listed property rules are introduced in the tax code to keep people from claiming tax deduction for personally used property placed under the appearance that it was used in trade or business. Listed property is a specific class of depreciable property subject to special set of tax rules. There are also special set of record-keeping tax aspects to it. Biggest example of this listed property, car. I can say that I'm using it for business, and if I'm going to say it's 100%, I better have another car someplace.
Yes.
Otherwise, they kind of know, no, you're kind of lying.
And if you're saying that you're using this vehicle for business, 100%. That's all I use it for is business. I go to and from this place with it. I transport clients with it. I would really like to see that car registered in the name of the business. If it's registered in your personal name, I'm not saying I won't put it down there, especially if you have a second vehicle. But it would be a whole lot better if that vehicle that you're using for business is registered to the business. So if you're running a landscaping service, Albrecht's Lawn and Trees, and you're wanting to you're telling me that your truck that you use for your business is 100% business because you've got your other truck for personal, that's fine. But I'd really like to see the truck that you're using for your business under Albrecht's Lawn and Trees.
And just so you're wondering, I actually do have the expertise to run that business.
So
I worked at a nursery for 15 years. I know what I'm doing.
So, not saying that I wouldn't if it didn't.
But it sure helps the IRS.
But it would throw up less flags with the IRS if, when I'm putting everything in and I'm giving you 100% of your registration as a business expense for the vehicle. You've got to have the vehicle registered in order to operate your business.
Right.
It's a business expense. If I put in there the copy of your registration as proof that you paid those fees.
And it goes even farther. I really don't want the two trucks under the same insurance policy at that point either.
No. I want a separate insurance policy for my business truck.
Yeah.
Versus my personal truck.
And so on and so forth as it goes.
You
Well, it'd
can.
be like your cell phone and
That's listed property.
That's listed
everything
property.
as business, like goes with this and that.
Right. And
Not
what
this
we're
one.
saying is, okay, this is a special property class. We understand that you're going to use it for business. But what we also understand is chances are you're not using it 100% for business. So we're only going to allow you a percentage. It's up to you to prove what the percentage is.
Right. If I've only got this phone and I come in here and I tell you I'm running a business, but this is my only phone, and I hand you 12 months worth of Verizon bills showing that I paid $100 a month for this phone, are you going to give me $1,200 for my phone?
No.
No, you can't, because it's my only phone, and I don't spend 100% of my time on this phone for business. We know I'm looking stuff up on here to buy on Amazon because my wife wants something. I'm calling my wife. I'm calling my buddies. What I'm using it for personal as well.
I better not have Candy Crush on it.
Yeah, you know, if Fetch is on here, I'm in trouble. You know,
Yeah.
but I can float to the IRS. Yes, he paid $100 a month for his phone, $1,200 a month. We're claiming a 50% business use of the phone. You know, if I'm running a landscaping business and I'm at work from 7 to 7 Monday through Friday, 7 to 5 on Saturdays,
You might be able to get that.
chances are I'm using this 50% of the time for business. So giving them $600 for business for cell phone use for the cell phone bill, the IRS is going to go, okay, yeah, we could see that.
So we just have to arrive at a reasonable percentage.
Yep.
Matt was using hours. That's a reasonable percentage to get there. He's using hours. Any way that you could get there, as long as it's reasonable. You're looking at a car, we're going to look at your miles. How much did you drive it for personal versus how much did you drive it for business? Well, if I'm taking actual expenses, that percentage makes a lot. You know, we don't necessarily worry about that percentage, how much your commuting was, because we're taking actual miles. So I only worry about the business miles, because I'm only getting that.
I'm only keeping track of that.
Yeah. So I don't care what the commute was. That's why I put in 0. I mean, I'm not taking actual expense. I'm just using miles. Well, if I'm using miles, what he drove is what he drove. If I'm using actual expense, then I need to know what your commute was also. What
Yeah.
your personal use was also. Because it's going to start driving down your percentage use.
Yep.
You could take that thought and extend it to anything that's a listed property. Technically, at one time, these computers, even in this office setting, were listed property. Because, hey, I don't have a client in here, I'm going to watch some YouTube videos. Or I'm going to surf the internet, I'm going to go on Amazon because I thought of something I need at home.
It's not being used for business. It's personal at that point.
It's a personal use, even though I'm on the clock. It's just that since there's not a client here and I don't have anything to drop off,
Mm-hmm. Yep.
and then the TV kind of personal. It's kind of a hybrid because I have it on for, I've got music going or something just kind of add to the noise of the place so people can't overhear people. But I also need it for myself because with the time I had this, if it's really quiet in here for a long time, I get a headache. I gotta have that background noise. I need that fan.
That's
Yeah.
why when you guys
I
come
have a
in,
fan on.
that's why when you guys come in when I'm alone over at the office, the TV's on. I may not be paying attention to what is on the TV, and I typically make sure it's something that's family friendly,
It's the noise.
but it's the background noise. Because if I'm sitting in that office by myself, even if I'm
Even at
in-
home, first thing, you go in, put your keys down, take your shoes off, turn the TV on.
I typically
about.
do. Yeah.
Just about.
Got some stereo
But I mean,
on,
even
but
if
yeah.
even if I'm sitting there and I'm engrossed in a Schedule C return and I am not paying attention to nothing else around me, if it is dead silent in there, it will drive me nuts and I can't focus.
Yep.
Yep, that's why I bought me a little.
But if I
That's
put the
so you
TV,
can use the
if I put the
radio.
TV on and I throw
Video on.
a movie on, family friendly movie on or whatever, I don't have to have it up real loud. Just enough to have that little bit of background noise. I can work all day long and never realize how much time has passed.
Yeah,
Last
oh, me
year I
too.
was,
I will recognize when the movie ends and nothing else comes back on.
Yeah,
last year I figured out how to use the radio on the computer. Matt says, you can use that radio over there. And I said, no, I'm gonna have it up louder. I just had it like at 2 for the volume, just enough so I could hear.
Well, you can you can go on YouTube and run
Music.
on YouTube off the TV. That's fine.
And that's what I do here. I have the TuneIn app installed on the Fire Stick. And so there's a certain station that I choose because it's public. And so no commercials.
There you
Yeah.
You know. Okay, so it has one drawback. During rush hour, it's telling you about the traffic in Minneapolis. Now, I know where all these places are, so it's like, oh man, that sucks. But nobody else cares.
I know a little bit, but not enough to know.
And when they tell me 494 is backed up at Linwood, yeah, I know where that's at. All right, so we talked about listed property. Listed property can also continue on to be, well, I'm not worried about this, marked police and fire equipment vehicles, ambulance and search hearses, any vehicle with a loaded gross weight of over 14,000 pounds designed to carry cargo, equipment and farm vehicles such as bucket trucks, cement mixers, cranes, forklifts, tractors, combines, delivery trucks with only the seating for the driver or with a folding jump seat, or buses with the capacity of at least 20 passengers. All these things still fall under listed category. Well, these are accepted. Because I'm not going to drive the combine to Dillon's.
why not?
Would be a pain in the ass.
Although I do see a lot of police cars in the Dillon's parking lot.
Go to Hutchins,
Fire
see
trucks
fire
in the
trucks.
Dillon's parking lot.
Yeah.
Yeah. And they're in the
Ambulances in the
Yeah, they're in the
Dillon's
shop.
parking lot.
Yeah, the firemen, will drive the fire truck up to the shop.
But
Your
they're
grocery
getting,
shop.
and they
Yeah,
can
but
park
they're
in
getting
the
the food
fire
for the
lane.
firehouse.
Right. Because they're only buying it for their shift.
Yeah. Yep.
Next shift, will buy their own damn
And I
groceries.
think they take it because if they get a call, they can stop what they're doing and go.
Right, and that's why they do that.
Yeah.
I don't care, as long as they bring puppies.
All right, so I want to depreciate listed property. To do that, I have to use it more than half of my business to even begin to have the idea that I could depreciate it. I don't recommend it. But you can. If you're taking actual expenses, you can depreciate your car. As long as you're using at least 50% of business.
This is where you talk your Uber drivers, your Lyft drivers out of that and explain to them that mileage includes depreciation. That you don't have to claw back.
Right. When you sell the car, you know, I have to include the depreciation that you took for it. And that can come back and bite you. Let me give you the example I've been sitting on. My landlord guy sold one of his properties. I don't think I talked about this, but I'm going to say it again. Because this is where it really came back and bit him. He sold one of his properties for $130,000. His basis in it was $96,000. So already he's thinking that, well, I only have to pay, tax on
40.
$40,000. Capital gains tax, by the way.
Mm-hmm.
Problem. He only bought the house back in 2002. The house isn't fully depreciated. So his basis is different. We have to take off all the depreciation expense that he's taken against it. So that now that $96,000 basis he had in it is now down to $50,000. Take the $50,000, compare it to the $130,000 that he sold it for. That's his gain on the sale.
$80,000 capital gain.
yeah, that really knocked him down because he didn't understand the rules and he didn't ask me. So again, if you're going to do that to a car, it's a 5-year property. If you're going to depreciate, you better make sure you depreciate it for 5 years. Don't get rid of that car.
You have to depreciate absolute everything.
No, you can, like we said, on the car especially, I could take mileage. And like Matt said, part of the formula for mileage on business includes some aspect of depreciation. That's why you have the 3 different mileage rates. You have the business miles, you have the volunteer miles, you have the medical miles.
Part of that 67 cents a mile is depreciation value.
And that's why the other two are so much lower. Because the depreciation value is not factored into volunteer miles and medical miles. And really what you could look at is the difference between the business miles and the medical miles. The difference is going to be the depreciation amount. Really. That's what it's going to break down to.
Just about.
Yeah, that's basically what they're taking out of that.
You get a
equation.
little bit of a bump for business miles over medical, because medical's still kind of personal. But
Yeah, but still, I mean, your biggest component on the change is going to be the depreciation that you're not getting.
yeah, on 67 cents, you're probably at 67 cents a mile for business. You're probably looking at about 32 cents a mile for depreciation.
Adequate records as far as the IRS is concerned for this. Account book, diary, log, other documentation, if it's sufficient and established to element expenditure of each use. If you're using a listed property and you're breaking it up between personal and business use, you've got to log it. If you're going to try and take that computer as listed property, which is a possibility, you kind of need to log. Well, I spent 3 hours surfing the internet for no good reason. I spent 6 hours on it doing work. On the phone. Spent 3 hours doom scrolling Facebook. And then the other 3 hours I spent, doing actual work. Answering texts or something like that. You need to log it. Technically. There's another thing that comes into effect. There are special limits on the amount of money that I can use as a basis. So I'm discouraged from going out and getting a Rolls-Royce Phantom and using it as my Uber vehicle.
There's only so much they will let you depreciate for.
You can't drive that
Vehicle.
brand new Camaro to pick up Uber. That electric charger you go on.
So we have to look at passenger vehicles, and that includes cars, but also trucks, vans meeting the definition are considered passenger automobiles. My truck is a passenger automobile for these purposes.
Mm-hmm.
Unlikely to be used, ambulance, hearse, vehicle for hire such as taxi are not passenger automobiles. The taxi is a taxi. Don't confuse, in this case, the taxi as the Uber. The taxi says taxi on it.
Yeah, if you have to have a special license to operate that vehicle and do your job, such as you have to have a medallion license to operate a taxi, then you're a taxi. If you're just going out and working off of an online platform or whatever, or you're going out and you're even if you're subcontracting for a taxi service, if you don't have to have a medallion license, you don't have to have taxi slapped across the top of your vehicle or on the sides, then you're not a taxi.
You're not a taxi. All right, so our limits. I can only depreciate $12,400 for the first, $19,800 for the second, $11,009 for the third, and $71.60 for anything else that's left. 5-year property on a car.
Mm-hmm.
So there's not much left. That's the maximum. So already you can see that I'm not being rewarded for going out and buying that Rolls Royce Phantom.
And that's only if you don't claim any bonus depreciation.
Yeah. If I'm taking 100% bonus, then why is it broken down into years? Because again, I've reached the cap. I'm going to take 100% of my allowable, but the amount allowable is only $12,400. The rest rolls over into the next year.
Well, if you take the 100%, it'll add everything up and give you that total number as if you had depreciated it for 5 years, whatever that number is.
Mm-hmm.
Now, here's the catch: the reason it breaks it down first year, second year, third year, and each year after that is if I buy a brand new vehicle, I buy a Ford 300, and I put it in service as a taxi, and I take 100% depreciation that first year, and I get the full amount on my special limits for passenger automobiles for that first year, and 2 years later, I get rid of it, I have to be able to figure out what I have to claw back. I'm only going to get my depreciation, the $20,400, the $19,800 for those first 2 years. The $11,900 and the $71.60 for the following years, that's going to get added back into my taxes as a tax.
Yeah.
Are you saying claw back?
Yes,
Yeah, that's
that
what he
claw
said.
it back. So when you do 100% depreciation on something that has a depreciable life longer than a year, if you don't keep that item for that full depreciable amount, whenever you get rid of that property, the other depreciation that you've already claimed the first year, you have to give back. And it goes on your tax return as a tax. So if you had a 5-year property and you got $100,000 in depreciation and you got rid of it 2 years in, and you should have only gotten $40,000 of depreciation, depreciating it out each year, then you'll have a $60,000 tax liability out the gate
Yeah.
That you owe?
Yeah,
because you
because
got $60,000 more the first year than what you should have. If you
Right,
take
that's-
that and you depreciate it out every year, then when you sell it after year 2, you don't have anything coming back because you haven't taken anything that you weren't.
Year 2 is the highest
Right, but
amount.
if
Wow.
you sell it, if you're doing it year by year like you should be, and you sell it before the depreciable life is expired, then you don't owe anything back because you've only taken enough depreciation for the years that it was in service. You're not claiming the other 3 years or 4 years of depreciation because you didn't take any bonus depreciation. That's where people get caught up. You know, and I've had clients come in. I had a truck driver come in 21. He bought a truck.
So
You only-
who does this officially affect the most?
Nobody, because we really try and talk him into
No,
taking
yeah,
mileage.
nobody. We talk them out of it. I've had one in the time I've been doing this. I had one guy. He ran a trucking company. He bought a truck and a trailer, $28,000 truck, $18,000 trailer, and wanted to do the special depreciation and get 100% for both of them. And I told him, I said, you understand, your tractor's a 3-year, your trailer's a 5, which means for the next 4 years you can't get rid of that tractor. Because if you do, we have to claw back what you got this year, and that goes on as a tax. Same thing with your trailer. If you get rid of that trailer anytime in the next 6 years, you're going to have to give back that money, and it's going to go on your return as a tax. Better to do those things year by year than it is to do it all at once. Something small like a computer that's a $300 computer, you can give them that whole thing because
If it went south and you no longer could use because it's not a huge tax hit.
It's a couple, you know, at best it's maybe $100-150 that's going to get added on. You do that with a highway tractor trailer, give him $200,000 the first year, and it blows up and he has to get rid of it,
Or it gets stolen.
or it gets stolen and totaled or whatever, and you've given him $200,000 that first year. Well, now next year going in, before you even add anything in, he's got a $150,000 tax liability for the depreciation on the truck that he lost.
That's why we don't recommend it.
Yeah.
And by the way, the limits are the limits at the top end. You don't automatically get this. I mean, if I'm depreciating a 1987 Yugo, I'm not getting 20,400.
No, that's just the maximum.
I might be getting 20 because what's the value of a 87 Yugo nowadays?
I don't know. It might be a museum piece.
Might actually be worth something. I don't know.
That kind of goes back to that. That kind of goes back to that question on charitable donations.
Yeah.
What's this hunk of metal worth? You know.
It might actually be worth something.
Yeah.
All right, so there are some special higher limits if I have a truck or a sport utility or a minivan or something like that built on a truck chassis. Because obviously they are more expensive. So my limits are just a tad higher.
And they do mean just a tad.
Yeah, they're not. You're not running off with this, but again. And on top of that, we're also discounting the percentage that you're not using it in business. You pay $25,000 for a car. Well, already I'm going to limit you, but then I got to adjust that limit because you're only using 50% in business. So already the $25,000, your only allowable depreciation 13 or
12.5.
12.5, yeah, 13 is 12.5. So it runs downhill. Now 179 is a little bit different because I can make up a number. I don't have to take it all. I can decide I'm going to take an amount of special depreciation under 179 rules saying I'm going to take a 20% bonus in the first year. Or a 50% bonus. Okay, I'm not really recommending this. Not really a lot of bonus to it, but it's available. And the other thing that you got to watch out for is that one that we haven't really mentioned about any of this is that I have to be showing a profit to be able to take the full amount of bonus.
Mm-hmm.
I can take all the bonus I want until I get to zero. And then it carries over to the next year. And once I've said that I'm going to do that, when it becomes next year, I have to continue that. Until I use it up. So again, another reason not to necessarily take it because it might not really help you. In the case of a highway tractor driver, really, seriously, dude. You might want to take the full bonus depreciation. It's not going to help you. Because I'm still going to get to zero and I'm going to stop there.
Yep.
179 applies to personal tangible property and other tangible property except buildings and their structural components. So our 27.5-year property or 39-year property need not apply.
Nope.
I can't take specials on some of the improvements that I do. But I can take a 179 on the roof. To help catch it up, maybe. That might not be a bad place to take it, per se. Because I know a hailstorm's going to come and wipe it out within the next 10 years. It might not be a bad idea, but I still don't recommend it. Tier 179 can't be done on the enlargement of a building, any putting in elevators or escalators or structural framework. So I put on a new garage. Nope. Add on a new bedroom. Nope. I can't take the 179. I can't even take bonus on that.
Mm-mm. No, that's its own. It's what, a 25-year property at that point for improvements.
Well, if it's attached, it's still since it might change the use. If I add on a new,
Like an escalator, I think those are like 25.
that's
year properties.
25. But if I put on a new room, that might be 29 or 27 and a half. Because I've changed the use. Instead of being a 4-bedroom, it's now a 5-bedroom.
Right.
I can revoke my 179s by filing amended returns, but yeah, as a general rule, I don't recommend special depreciation. It's going to come back and bite you for the most part. Like Matt said, if it goes out of service for whatever reason, you have to recapture any unused
That you've already taken.
that you already took because you weren't allowed to take it. You didn't have it.
General rule: if somebody brings in stuff and they've got a list of property that they've purchased, if that property is $500 or less, I have no problems just running it up on a depreciation sheet and letting the system put in the 179 in the bonus. Especially if it's something like a computer, a $300 computer, a $500 printer, something like that.
Are those default callbacks?
Yeah, and if you just go in and you put everything in, this is the date I put it in service. This is the amount that it costs. We haven't taken any depreciation yet. This is the convention. This is the method, and leave it at that. The computer will figure up everything else. It'll do your 179. It'll do your bonus, and then it'll do the depreciation. It'll run it all out to zero. So that $300 computer he bought, he'll get $300 for this year. And if
Not as a refund, but as a.
no,
As an expense.
It's as an expense for the business.
Up
So-
to the point where he's not making money.
Right,
Once he gets to zero, the special stops
right.
and goes to next year.
So something like that, where he's got 500, got an item that's $500 or less, whatnot.
And I might not ever hear about that, especially when we're talking about the computer. He might never tell me that, hey, yeah, the lightning struck my place and zapped my computer, so I had to buy a new one. He's not going to tell me the fact that, probably not going to tell me that. He's going to have a new computer, but he might not tell me what happened to the old one. And I don't really need, I should know. He should tell me. But I don't automatically think that, well, you bought a new computer because the old one went south on you. I'm not automatically thinking that.
Yeah.
Can't take more than 100 or 1.2 million, roughly, in 179 deductions. Again,
They upped it a little bit.
and this is allowable for inflation. So again, never get married to the numbers.
Yeah.
Investment limits, $3 million. Again, not really worried about that. Let's see here. Again, when we're talking about business income limit, I can't take specials past zero.
It's kind of like a non-refundable credit. You can take enough of it to bring yourself to zero, but not enough of it to give yourself a net operating loss
Or a refund.
or a refund.
Well,
It can result in a refund.
it can result in a refund, and it's not necessarily totally limited to. There is a cap to this, by the way, but it's not limited to my business income.
Right.
If, like for instance, I'm running a business and I want to take a big, huge depreciation expense, I can go past zero because I'll start counting against my wife's income. I can't make my net income on the overall return go past zero.
So if he can take a big enough expense on his business to cover not only all of the income from his business, but the majority of the income from his wife, and then after standard deduction, they're at $0 of taxable income.
But that's where they prefer to be.
Right.
least,
Right.
Not overly.
Yeah, but you might, if you keep doing that, you're gonna have some questions. So again, not the strongest recommendation.
Right.
It causes long-term problems. So we have Vince. His net income was 11,340, and no other income. He purchased equipment costing 15. He wants to take a 179 deduction. His wife's wages were 19. They're filing jointly. His taxable income for Section 179 purposes is 30,340. So Vince can take the entire 15,000, even though it made his business income go in the hole. His overall return had enough income to support it. But looking at that, it's like, okay, I'm gonna take 15 away from the 19. They're gonna qualify for EIC.
No, they won't.
You think it's
No, they won't. Their total income is 30,000.
Oh
Now,
yeah, you're right.
they might, if they had 2 kids or whatever,
Yeah,
they
something
might
like
get some
that.
EIC.
Yeah.
But the 30,000 for the EIC is going to be the first
Right.
killer.
Yeah, you're right. I was not thinking about that. Gross income versus earned income. Yeah.
Yep.
But it's something the IRS would definitely be on the lookout for.
Yeah, if he's doing that every year, if he's knocking down his total income so that it's under his taxable income, so he's never paying taxes.
Right.
The other drawback to think about is this too. The first thing they're going to do on that special is they're going to take it against his business income. So his business is going to be 0, so he's not going to pay any self-employment tax. If he does that every year for the next 30 years,
So he goes to retire.
and he goes to retire, he's going to have a problem because the Social Security Administration is going to go, you've not paid anything in. You haven't paid any self-employment tax on your business in 30 years.
You haven't paid Social Security tax, period.
That's like my dad. He being self-employed, he can't retire because he never paid in the Social Security.
Can you pay as a lump sum any of that back if he won the lottery?
No.
Because he's not working.
Any cost not deductible due to tax income limit is carried over to future years. And like I said, once you started this, you can't stop.
I mean, if you think about it, even if you won a $10 million lottery,
You're not getting no
you're only going to be able to
That's
put
gonna
in
go towards
$165,000 for Social Security because at that point it ends. You don't put in any more.
Plus, it also becomes income, doesn't it?
Well, it becomes income, but I mean, if you won a $10 million lottery and you had your taxes withheld, federal,
That's just
state,
that's just income tax.
and everything else, it's just basic income tax. Once they hit $165,000,
It'd stop anyway.
it stops.
Oh,
So the fact that you won $10 million is irrelevant. You're not going to pay.
That
You're
much
not
in.
going to pay 12.4% of $10 million to Social Security. You're going to pay $165,000, and that's it.
But if I won $10 million, I really don't need Social Security anymore.
Exactly.
Unless
All
you
right.
wanna bait your
This
shopping
is
spree and
not
spend it
important
all.
anymore, but there is an order of operations to taking both of the special depreciations.
Yes.
Take your 179 first, then take that remaining basis, and you can take the special on it. But since the special right now is going to be 100%, why take any 179? It's ridiculous. Because the special is, like we said, it's all or none. Well, if it all is 100%, I don't need a 179. It's ridiculous.
Yep.
Amortization is, like we said, some other things. It's a straight line. The depreciation, they deduct equal amount of the cost of the property over time. They're not as complex, they say. You figure your amortization by dividing the cost of the property by the number of months in the period, and multiplying that times the months in the tax year. Generally, after the first year, you'll deduct 12, which is all 12 months. any intangible property the taxpayer placed in purchase for use in the trade or business is amortized over 180 months, 15 years.
Yep. So the first time, if like for the landlord that had to take his house out of service and repair it, he spends $30,000 repairing the house and puts it back in service. Okay, he puts it back in service in June, so he gets 6 months of amortization
On
on
the
that
30.
$30,000. So you take that 30,000, divide it by 180, and that number plus 6 is what he would get that first year.
Mhm.
Then every year after that, it would be that number times 12 until
And
it was depleted.
In 15 years.
Yeah,
So on year 16, he's going to get a half a year.
another half a year, right?
Some things that amortize: goodwill, franchise, copyrights, customer databases, licenses, permits, government granted rights, covenants not to compete, business startup costs, which is where I was throwing my landlord when he was revamping that cheap property that he bought. It was never available for rent in the first couple of years, but he kept spending money on it. I kept keeping a track of it, so that when he actually listed it for rent, I could start.
Mm-hmm. That way he's not out.
For that unit.
Yeah,
For that unit.
yeah.
He just didn't get it. I mean, and he didn't understand, and I had to fight with him a little bit about rules. But he didn't understand. I'm spending money, and you're not showing me a loss. Well, I can't, because it's not available to rent. It's not an actual
Because
property.
there's no loss at that point.
Yeah, well, yeah, I just can't take those expenses. I understand I understand your complaint. I understand the confusion. You cannot do it by rule, because it's not this investment property, and that's what it is. It's an investment property, and it's not capable of making any money. Until it is, you have to sit on these costs. And as soon as it's available, I can start depreciating them under its own thing.
Yep.
I went around with him for 2 years because it took him 3 years to get it ready. Because he had other things to do. I mean, it wasn't, it was the weekend project.
He'd go over, do a little bit, go over, do a little bit. Finally, it was ready.
Yeah. $45.62 is our form to tell the IRS what I'm doing, when I'm doing it, and how long it'll last. And like I said many times, I'm only using $45.62 in the first year. This is what it looks like.
Whole great big ugly thing.
Yeah, 2 pages. We already saw this aspect of it right here. And that's where we do most of our work.
Yep.
But there are other aspects over here talking about specials. There's other aspects over here talking about vehicle use. For my listed properties, for instance. That's all in this area up here. This one down here I have not messed with. Question for employers who provide vehicles for use by their employees. Yeah, well, we don't have those clients, so I'm not worried about that section. But this is where I'm telling the IRS the rules for what I'm doing.
Yep. Somehow I don't think Brett's going to buy 5 vehicles and park them at each office so that his employees can have a company vehicle.
Yeah. Well, it'd be nice.
It would be.
Yeah, but he could also pay us if he put stickers or magnets on the car.
IRS is rather restrictive on that.
Yeah.
They're not. Remember, because during COVID, that was a big thing. This is how you make some money. So you sign a contract that you're going to put this magnet on your car and drive around. Yeah, the IRS got wise to that in a hurry.
Yeah.
With the technology nowadays,
Yeah.
No way.
Well, we used to have a truck that drove around too that had
That's different.
the
yeah,
billboards
that's
or whatever
different.
on the side.
That was different.
That's different. I mean, if his whole business structure is structured around
That advertising vehicle.
him taking money from companies and him running a portable rolling billboard, and he just drives around all day long with the advertisements rolling across the sides of his truck. That's completely different than me going out and buying 5 pairs of Liberty Tax magnetic stickers with our address and our phone number on it and slapping it on everybody's car. Now, I can take the cost that I expended to buy those magnets
It's
as a
advertising.
business, as an advertising expense. But you can't claim, you can't sit there and turn around and say, well, you know, I put 8,000 miles on my car this year. That's business miles.
Yeah, they're
Because
not going to allow
Matt
that.
put a Liberty Tax magnet on my car. I am advertising Liberty Tax wherever I go, so all of my mileage is business miles. That's not gonna fly.
No, the IRS nixed that in a hurry.
Yes.
Because, like I said, during COVID, that's what people were doing. It's like, okay, you're going to put the
Either
magnet
way,
on my car,
we never did.
and then whenever I drive to the store, whenever I drive to the bank, that's advertising miles. No.
I'll give you a prime example. Okay? And I went round and round with her on this. Maurice's dad owns a plumbing company. Okay? Maurice's dad was fond of taking the family out to dinner, sitting down, and after all of the food came, he would stand up and say, "Thank you for attending this meeting of Shaple Plumbing."
Oh,
Sit
God.
down
Nope.
and claim
Absolutely
the
not.
dinner as a business meal.
No.
No, that's not how that works. It's family, so there's no potential clients,
Not really.
Big discount,
but the,
100%.
the first year that we were doing her dad's return, she came in and she brought all of his stuff in, and there was like $3,000 worth of business meals, and that's when she told me this is how he gets his quota for business meals. And I said, yeah, you can't do that. That's not a business meal. And she's like, yes, it is. He's claimed it as a business function. I'm like, but there's no potential clients. Who are the potential clients? You guys are family.
He's dropping, sitting around.
You guys are family, not clients.
IRS is not going to take that.
Yeah,
Yeah,
IRS
there's
is
no
not going
proof.
to take that. But, and we went round and round with it, and I told her, if you want to give it to him, you do the return. I'm not going. Because I've already told you that's not going to fly.
Right. All right,
That's what she
disposition of property. This is when you get rid of it. Sale, exchange, retirement, abandonment, or it's actually just destroyed. Generally, a gain or a loss is recognized. This is a capital transaction still. And I am allowed to take my depreciation for that year. But only half of it. So, like, if it was a 5-year property and I'm in year 4, I don't get the full amount of year 4. I get half of that. Because it's the last year, it's considered on a half-year convention. I'd only get half of that last year. Again, the computer would hate this. Just understand. This is why it happened. Why that depreciation number isn't as big. Or why it exists. If that was the only thing.
Yeah.
So 22 Tito's Toys bought desk for $3,000, 7-year property. It sold the desk in 24, so they're 2 years in. Using half-year convention, the business used for year 3 is $525. Because they got rid of it year 3, they only get half of that. Because it was the last year.
Well, they got rid of it because they were doing the year to year. They could only take the depreciation up to when they disposed of the property.
Because they don't own it anymore.
And they don't have anything clawing back because they didn't take more than what they were entitled to for
Right.
the use of the property.
Because they didn't take any specials.
Right.
So what's needed to depreciate property? I need to know when you bought it, when it was placed in service, actually. What you paid for it. I need to figure out my method, my recovery period, my convention. Is it listed property? Is it a car? Is it a truck? Is it a van? If it's property, I need to know the value of the land and subtract that away.
Yep.
And how much of it's actually used in business. And when you sell it, I need to know when you sold it, how much you sold it for. Did you have any costs involved in the sale of it? Did you pay a commission?
Did you have to pay to have it appraised?
Yeah. All right, I didn't take it over too bad.
Yeah, 15.
We'll see you next time, and we won't talk over. We'll talk about something so complicated.
Remember, I won't be here Wednesday.
Good.
Ah, goodness.
I'll be watching it online now.
Boo! Oh.